Before tea time, this one, and after tea time, we go for MSME schemes and also see credit risk management. May credit monitoring tools are there. Those tools also we will discuss. So another one point I want to tell, wherever it is important for exam, there I will explain in detail, and wherever less important one, I will go a little faster so that we can adjust the time. This is what I plan normally in our promotion classes. So now I will start with non-fund based limits, which we could not cover in the last session. Okay. So here, two types, mainly we call a non-fund based. So many are there, but for exam purpose, bank guarantees and LCs, letter of credit. So bank guarantees, briefly a contract. It is a contract of suretyship. I will tell you how the bank guarantee is. Our customer will be there. He is doing some contracts with the government department. And the government department may have some doubt that whether this contract will be in a position to complete the work in time with quality, same quality, whatever agreement is there as per that. So government department may have the doubt. To clear the doubt, what they say is, you arrange one bank guarantee on your behalf. If your work is as per our terms and conditions and it is finished in time, then there is no loss to us. We will not touch that guarantee. Otherwise, we will take amount from bank. This is what they ask our customer. So our customer will come and ask us, sir, you arrange a bank guarantee favoring so and so government department for this much amount. So we issue guarantee. Here, three parties are involved. One is banker. We are giving guarantee on behalf of our customer. He is borrower customer and we are guarantor. And whom we are giving guarantee? Government department. We are giving guarantee. So it is called as beneficiary or creditor. So three parties here. So on behalf of our customer or debtor, we are giving surety that he will complete the work. Otherwise, we will pay the amount which demanded by you. This is called as performance guarantee. Normally in performance guarantee, it is not that if contractor is not in a position to complete the work, we will go and complete. It is not like that. Only amount we will give. This much amount we will pay. That will be mentioned in the guarantee. This is briefly about performance guarantee. And the next one, suppose one party is purchasing machinery from a machinery manufacturer, our customer. Normally, we give term loans for purchase of machinery. But here, party says, sir, that supplier of machinery himself is giving me some time, that he says, I can pay in 3 years or 4 years or 5 years in yearly installments. Some balance, first initial amount, some 10% or 20% he may pay. Remaining balance is payable over 3 or 4 or 5 years, whatever the period may be, in installments. But for that, machinery supplier says, I don't know the customer's position after 2 or 3 years, whether he will pay to me or not. He will have this doubt. So to overcome this problem, supplier of machinery says, you arrange one guarantee from your banker, stating that if our customer in a party who is buyer, if he doesn't pay installment in time on agreed date, then he will ask bank that you pay because he is not paying. So here we give surety on behalf of our customer to the machinery supplier, stating that on due date, you demand the amount that fellow borrower. If he is not paying, then we will pay. So here by installment basis, yearly installments will be there. We are guaranteeing future installments. Here, this is called as deferred payment guarantee. What is deferred payment? Machinery supplier, instead of taking amount upfront, that is immediately, he is giving some time, that is called as deferred installments. Those deferred installments we are guaranteeing, it is called as deferred payment guarantee. Now in exam they are asking, what is the difference between term loans and deferred payment guarantee? In term loans, we will give loan immediately. That means loan account will be created immediately. We will give funds to the machinery supplier. Whereas in case of deferred payment guarantee, only guarantee we are giving now. If at all that borrower doesn't pay, then only we will pay. So the difference between term loans and deferred payment guarantee is outlay of funds. Answer is outlay of funds. Whether immediate outlay of funds takes care in term loans, whereas future outlay of funds may or may not take place. This happens in deferred payment guarantee. This is second one. And third type of guarantee, it is advance payment guarantee. Advance payment guarantee. Suppose our customer is there, he is buying some advance from a supplier. Sir, he is buying some commodity from a supplier. He is buying commodity from a supplier. So the supplier has to supply to our customer. But here, the customer, it doesn't know that after supplying material, this customer will pay the amount or not, that doesn't know. And sometimes what the supplier says is, I want some advance money because I have to manufacture material and supply to you. So I want some advance money. Then our customer says, okay, you arrange guarantee from your banker. Then I will give you some advance money. Basing on that, you procure raw materials and prepare material for me and give it. So the supplier will go and approach his banker and guarantees the amount given by our customer or this buyer to supplier. This is called as advance payment guarantee because the supplier of material is receiving some advance money, and after receiving that advance money, whether he will be in a position to supply material in time or not, we don't know. For guaranteeing this, it is given. This is third type. Okay, only important aspects we are covering. Sometimes for tax purposes also. Yeah, slides not changing. Yes, sir. I will change whenever required because I am explaining directly. No issue. Right. So sometimes we will be guaranteeing payment of taxes for customs, etc. Then they are called as financial guarantees. Whenever we are guaranteeing some future finance, they are called as financial guarantee. Whenever we are guaranteeing performance of the contract, then it is called as performance guarantee. Sometimes they are asking, they are giving 3-4 types of guarantees. Which is financial guarantee, which is performance guarantee, like that. Except performance guarantee, remaining all are financial guarantees. Okay, now, so next one, types of guarantees we see. One is financial guarantee, taxes, etc. Performance guarantee, we have discussed this. Deferred payment guarantee, that's what future, whatever payables by our customer to the supplier of machinery. And advance payment guarantee, this is for supply of raw materials. These are important guarantees. For exam purpose, I am telling us. Next, branches are not empowered to issue guarantees containing onerous clauses. Onerous clauses means it is not normal, some abnormal clause we call. What is example is automatic renewal clause is considered. Normally, we give guarantee for period. Say customer may ask, sir, 1 year guarantee is there. 1 year guarantee we will give. After that, 3 months will be again claim period will be there. Normally. So 1 year guarantee, after 1 year, automatically it will be renewed if contract is not completed. So if such clause is incorporated, we call it as automatic renewal clause. Guarantee will be automatically renewed for a further period normally. So here we don't know up to what time renewal. So this risk is more in this. That is why it will be considered by circle head and above authorities. Normally, branches are not supposed to issue guarantees containing onerous clauses. Onerous clauses may another one important is that protective clause will be there in every guarantee. Protective clause. What is the protective clause? Notwithstanding anything contained herein, our guarantee is restricted to so and so amount. And you have to claim the amount maximum by so and so date. That is what maximum date. After that date, we are not liable. This is what we mention in protective clause. Without protective clause, if you issue, it is called as again onerous clause. It is considered by CO head and above authorities, right? Next, delegation of powers. Normally, branches can issue up to 3 years bank guarantees. 3 to 5 years, branches can issue if it is headed by scale 4 or scale 5, 3 to 5 years. If up to scale 3 headed branches, then they have to take up with RO head COC for 3 to 5 years. And above 5 years, generally RO head and above authorities, they will give basing on type of guarantee. Normally, guarantee period should be maximum 10 years generally. So even if they are giving 100% cash margin, 100% cash margin kya hai? Suppose party asks 10 lakhs rupees bank guarantee. For that, what we say, at least you give us 25% margin. Here, margin means in the form of KDR, term deposits, we will take at least 25%. Remaining 75%, we ask them to give some type of securities like land, building, whatever it is. So here, with 100% cash margin means 10 lakhs guarantee they are asking, and the entire 10 lakhs KDR they are keeping with us. In such case also, branches are not supposed to give for more than 10 years period. Again, there also, GM, HO, CAC and above authorities, they are empowered to permit. And another guideline, bank guarantees may 50,000 and above shall be signed by 2 authorized signatories. Next, common guidelines, quarterly report, status report ke liye, because we are giving guarantee, performance guarantee, and whether we don't know whether that fellow is completing work as agreed or not. For confirmation of this, what we say, Baba, you submit as quarterly progress report of your work. When we will ask if our guarantee is 5 crores and above, then we call from the party, you submit a status report of the work completed, so that we will assess. This is what 5 crores and above, quarterly report, status report, party has to submit. And third party deposit, normally it should not be accepted for cash margin. Earlier I told you 25% minimum, we insist cash margin or some margin. It will be in the form of, mainly maybe in the form of KDR, sometimes other paper securities also we accept. So if third party KDR is there, that we cannot accept for margin, but we will accept is a collateral security, that one, not as a margin. This is another guideline. So generally, guarantees, central government related guarantees, normally it will be issued in the name of President of India. But we have to correspond with the department which has asked the guarantee, not with President. Similarly, state government guarantee, whenever guarantee we are issuing favoring state government, it will be addressed in the name of governor of the state. But we cannot correspond with the governor. Which department has asked this? With that department only we will correspond. This is about briefly. Next, small this one, how we assess bank guarantees. Because in some STs, they told in other states, guarantees also we have to cover how perform, how to assess. So briefly, for easy understanding, only one example I have taken. This is for performance guarantee. How we assess average monthly contracts awarded. How we will come to know average monthly contracts? Previous year, whatever the turnover was there, contracts total, that we take divided by 12 months. So now we come to know what is monthly contracts that fellow is getting. So here we will take first one, monthly contracts, how many awarded. And second one, requirement of bank guarantee per month. Normally 20% of guarantee they will ask, performance guarantees made. So per month, what was the guarantee, total contract amount? Out of contract amount, say per month 1 crore is contract. he is getting. Last year his turnover is 12 crores. Example. Last year his 12 crores. Out of 12 crores per month, it is 1 crore per month. Right? Now, 1 crore per month turnover may 20% he require guarantee for this. So 1 crore may 20% is 20 lakhs. So for one, it is 20 lakhs. Average monthly contracts he require 20 lakhs. Suppose contract is for 6 months total guarantee. So 6 months into 20, 1.2 crores. This is what his requirement of bank guarantees. So annual turnover divided by 12, it comes monthly contract. Monthly contract may 20% is requirement of bank guarantee, 20%. So this contract, how many months it takes normally, 2 months or 3 months or 4 months or 6 months, basing on that, we will multiply this months with the requirement per month, so that it will come what is his requirement of bank guarantee. Simple, right? Next, we go for next one, letter of credit. Letter of credit may I will tell you first mechanism in this, so that we will come for this how the letter of credit will take place, so you will understand. Right now, this is buyer. Say here it is mentioned as Paris, doesn't matter. It is take our country. Our customer is buyer. He is buying some machinery or material from seller in other country. Say here it is mentioned Canada. Okay. So our customer is buying some material or machinery from abroad. Then this fellow will prepare that material or machinery and supply to this person. But here what happens? Our customer doesn't know anything about abroad customer, whether he will be in a position to complete the agreed work or not and supply the material in time or not. This fellow doesn't know. And what about this person, seller को? This buyer he doesn't know. Suppose ये मटेरियल पूरा बना के बेच देगा इसको, बेचने के बाद whether इसको पैसा मिलेगा या ना मिलेगा, this problem is there. So whether I will get my payment or not in time, this fellow will have doubt. इसको whether he will be in a position to supply my material or not, this is the doubt. To clear this, what happens? Letter of credit has come into existence. Letter of credit. So what this letter of credit says, the seller will ask buyer, so you arrange LC from your banker. What is that LC? This fellow will prepare material or machinery and he will send through shipping documents, bill of lading we call, through ship or airways or whatever mode, he will send the material and send all documents including invoice, airway bill or shipping bill, everything to our banker, so that on receipt of these documents, we will pay the amount to the seller on due date. If it is a demand bill, immediately. So here we are guaranteeing to the seller that you prepare material and supply to the customer and send us all documents, including invoice and bill of lading. Bill of lading is shipping bill or airway bill if it is shipped through air. So you send us invoice, bill, etc., whatever insurance, all others, so that we will pay the amount provided your all papers, whatever we receive, that is shipping bill plus invoice plus insurance and other related documents, whatever it is mentioned in LC, all documents are received correctly. Then we will make payment on agreed date. This is what we are guaranteeing. This is called a letter of credit. We open letter of credit assuring the seller that you prepare material and send it to the buyer on due date. You send all papers to us. We will make payment on due date if this fellow is not paying. This is what letter of credit transaction. But here some more additions. I will not add all to avoid confusion. What we say is Canara Bank is issuing here LC. It is called as issuing bank. Suppose this fellow is having account in Citibank. So what we say, we send LC directly to Citibank, and Citibank will advise the seller Yes, I received LC through net again. So this fellow will advise him that I have received shift message here. He will receive shift message. SWIFT. SWIFT means Society for Worldwide Inter-Financial Telecommunications. SWIFT message we call. Normally, international transactions we send through SWIFT message. Society for Worldwide Inter-Financial Telecommunication. So we will send SWIFT message to advising bank. This advising bank will tell this fellow, Are Baba, we received SWIFT message, LC opened by your customer. Now you can sell, you can prepare and send material so that on due date, you present us documents, we will send to this bank and collect the amount. That's what this fellow says. So on due date, he will give documents to this advising bank. Advising bank will send to our bank. We will tell the customer, yes, we received all documents. So their 5 days time is taken to verify whether documents are good or not. If at all discrepancy is there, within 5 days, we will advise the branch and they are not in order, we will not make payment. If everything is okay, yes, we confirm, we will make payment on due date or immediately whatever agreed terms. So here buyer, seller, buyer is our customer, applicant, seller is beneficiary, issuing bank is our bank, we are issuing LC, and we send the seller's bank, that is called as advising bank. And one more terminology I will ask. Here, seller says, I am not having account in this Citibank. You send to HSBC, I am having account, Hong Kong and Shanghai banking. So what this fellow says, he will submit documents to HSBC and then he will directly contact us. So he will negotiate. Negotiation means he will reimburse first. He will negotiate bills through this HSBC. Then we call as negotiating bank. Then bills will come to us. We will pay to this bank and he will receive. Suppose sometimes what is our bank, he says, this fellow, I don't have confidence in this bank. But here we are having State Bank of India, some other bank, which is bigger one. So this State Bank is having branch here. You arrange funds from this bank. So we will talk with State Bank of India and tell them on due date, you pay amount to this bank. So this is called as reimbursing bank amount. So all these are again further for exam purpose. I don't want to go into detail. Only LC mechanism, how it goes, you understand. Then we go for different definitions. Only for exam purpose, they are asking about definitions only. That is why, yeah, somebody asked about PPTs, everything. I will forward you these PPTs, no issue. Right, sir. Okay. Now, first, types of letter of credit. Irrevocable letter of credit. What is this irrevocable letter of credit means? Either seller or buyer or anybody, they cannot change terms and conditions after issuing LC. Then it is called irrevocable. Irrevocable only, right? Next, revolving letter of credit. This is nothing but just like OCC. Once he has availed that LC is closed, then same amount again we will permit. This is what revolving amount, just like running account. Confirmed and unconfirmed letter of credit. Confirmed, I told you earlier example, in Canada, Citibank, that fellow is not having any confidence in our bank. Then he says, you confirm from State Bank of India. Then, yes, we will do confirmation through State Bank of India. It is called as confirmed letter of credit. It is only arises in case small banks or any not that much bigger good banks. In such case, it will come. Next, transferable credit. Transferable credit can be transferred in the name of other person. That means we are opening LC in the name of beneficiary. The beneficiary may transfer this LC to another one person, provided it is a transferable LC. Whom he will transfer? He may be buying material from somebody, raw material. So them they may transfer. So this is what transferable credit. But transferable LC only once it can be transferred, not more than once. एक बार transfer किया हो गया, दोबारा नहीं होता. Next, back to back credit. Here we are opening LC in favor of our customer and sending it to the other bank, to the buyer. What this buyer will do, uska bank में ये letter of credit के ऊपर he will arrange LCs to his suppliers, because he will be buying material from local suppliers. So on the basis of our LC, the other bank will open some LCs favoring suppliers of material to seller. This is what back to back, and basing on this they will issue other LCs. Standby letter of LC, this is recalled question several times. Standby letter of credit means just like bank guarantee here. Here no goods, we are not concerned about goods, bills, etc. Kuch bhi nahi. Just like guarantee, on due date, party will give you amount. If party doesn't pay you on due date, we will pay the amount like that, we will give. This is called standby letter of credit. Generally, it is valid for 1 year. Next, clean letter of credit. This is also recalled question several times. Clean letter of credit means we are receiving documents, but these documents doesn't contain, it need not contain bill of lading or any goods transport करने के बाद they will receive either airway bill, shipping bill or air bill, whatever it is. So this document he is not submitting. He may send it directly to the customer, our buyer, and other than shipping bill, bill of lading, remaining bills he may send to us. This is called clean letter of credit. It is not accompanied by shipping bill, airway bill or bill of lading. Then it is called clean letter of credit. And two more types are there. I will discuss those types. Red class and green. It is not there in the menu. Red class and green class letter of credit. These are also recalled questions in exams. Red class letter of credit means basing on this LC, party can avail. Who is party here? We are issuing LC to a foreign person who is supplying material to our customer. So basing on this LC, the other country may supplier hota hai na, that supplier will avail finance for raw material, etc., and supply material to our fellow. That means our LC is providing finance also to the supplier. Then it is called as red class LC. Green class LC में apart from finance for procuring raw material, warehouse के लिए भी उसका rent कितना होता warehouse का, that provision also included. Then it is called as green class LC. Red class LC, green class LC. Bas, this is briefly about LCs and bank guarantees for exam purpose. Then restructuring ka next I will come in MSME policy, this one. Now, we go for CRM policy. As I told you, it will take half an hour to 40 minutes. Credit risk management policy में policy framework, policy work, framework means structure at head office level. This risk management का structure, what is the top board is called as board of directors होता है ना. It is risk management committee of the board. It is apex one at head office level for this risk management committee of the board. So it will have all top people, our MD, EDs, directors, etc. Right? Next, inspection wing, normally they conduct this effectiveness and implementation annually they will do. It is not inspection wing here. This not RM wing. Inspection wing will conduct independent assessment of the effectiveness of this policy annually. Next, first day I discussed credit risk kya hai. Credit risk definition, sometimes they are asking. Credit risk is nothing but we are giving loans to borrowers. Borrowers may default in repayment, either installment or full amount, whatever it is. They may default. This is general. So for how we call it as probability of credit risk is possibility of losses associated with default by counterparties to meet obligations. Counterparty is our borrower. What is obligation? To repay the loan in time. He is not repaying, then it is called a default. And default is again when it is classified as NPA, we call it as a default. This is what credit risk. Failure of counterparty to meet obligations, right? Retail loans, what happens is, for 50% example they have given, how it is retail loans, I will tell you. Suppose one party is enjoying 10 crores working capital limits and another 10 crores term loans he is enjoying. We have given him a car loan under retail lending, car loan. So what our RBI says, if one loan of the party becomes NPA, all other loans also should become NPA. This is what RBI guideline. But here, in case of your car loan, it is small amount only, maybe 50 lakhs. This fellow is not repaying installments. Then it has become NPA. So if it becomes NPA, other 20 crores I know, 10 crores working capital and 10 crores term loan, that also should become NPA as per RBI guidelines. But for retail loans, some leverage is given. If entire retail loans I know, usme overdues 50% exceeds overdues, then only you can classify other accounts also as NPA. That's leverage is for retail lending bus. Next, expected losses and unexpected losses. First day itself we have seen, we will calculate expected losses basing on this equation, probability of default into loss given default into exposure at default. Basing on these three, we calculate expected losses, and these expected losses after calculation, we will cover by way of two things. One is pricing, second one is provisioning. If high risk means we charge a higher rate of interest, that is pricing. If high risk is there means we charge more provision. This is what provisioning. Low risk, suppose a person is rated as high risk, 150% risk weight. So provisioning will be more for this. Next, unexpected losses. Over and above expected losses, we call it as unexpected loss. Then it will be capital. Our capital will be taken care. That is why Basel has come into existence. This also we have discussed. Probability of default. We are giving one loan. What is the probability that this loan may become default within 1 year? Maybe 0.001% or 0.0, like that we will calculate this probability of default basing on migration analysis. Again, what is this migration analysis? This year, the account has become, this year it is good, rated as low risk. Next year, it may go to normal risk. Next year, it may go to moderate risk. Subsequent year, it may go to high risk, like that. So in how many years it is becoming NPA, which is only probability calculation. Like this, 5 years data, our people will take at head office and calculate probability of default. We need not worry at branches level, but head office will take care all these three: probability of default, loss given default, and exposure at default. Basing on this, they calculate expected losses, and these expected losses will be covered by way of your pricing and provisioning. Unexpected losses are covered by capital. Bus 2 points for exam purpose. Next, risk management committee. I told you it is top one. Then risk management, credit risk management committee. This credit risk management committee, again MD, EDs, and wings heads will be there here. They decide delegation of powers, collaterals, pricing of loans, provisioning, etc. So here exam they may ask who decides delegation of powers, collaterals, pricing of loans, provisioning, etc. It is credit risk management committee. It contains MD and CEO, EDs, and wing heads. Top body, right? Next, CGM or GM of risk management wing is called as Chief Risk Officer, right? Whatever any important voice, yes. Turn your volume. Okay, volume I will increase. Volume I have increased to the maximum. Yes, sir. Okay. Next. Borrowers rated moderate risk and better, they are termed as investment grade, and we sanction loan to such people are good rated one only. So here that moderate risk is equal to BB, external agencies ka. Suppose anybody is rated as high risk, that is below BB is B, and grade absolute C, D, like that. So those loans, no authority other than CAC or board, they can sanction high risk accounts. High risk accounts normally nobody can sanction other than CAC of board and above. Above CAC ke ek hi hota, that is MC. That means CAC and MC only they can sanction high risk accounts. And again, small loans, that power delegation of powers diya, these are applicable to larger big loans. Next, this point also first day I have discussed. Total eligible provisions. We are making provisions. For standard assets provisions we are making, doubtful, loss assets, substandard, all assets we are making provisions. These provisions, whatever we are making, if they are more than expected losses I told you, basing on 5 years historical data, we calculate at head office level. So if provisions are more than expected losses, the differential amount, whatever it is there, exceeding expected losses, that can be included under Tier 2 capital up to a maximum of 0.6% of credit risk weighted assets, subject to RBI approval. Actually, present guideline, what is this for this? Under Tier 2 capital, it is mentioned, it is up to maximum 1.25% of total provisions, whatever it is there, general provisions and loss reserves we call, all these provisions up to maximum 1.25% of your risk weighted assets maximum, they are included under Tier 2 capital. That is as per standardized approach, which we are following now. In future, if you migrate to advanced approaches, then equation will change. Instead of 1.25%, it will be difference. That means amount exceeding provisions more than expected losses. Provisions more than expected losses, whatever it is there, that portion only, that to up to 0.6% of risk weighted assets. So what is here again, risk weighted assets? Our loan should multiply with risk grade, which it has got. For each risk grade, risk weights are given. That I will come in future also, I will tell you. Next it will come risk grades, then I will tell. Okay, next. Suppose if expected losses exceeds your eligible provisions, that means losses are more than provisions. Losses ज्यादा है तो क्या होता? Equity, common equity हमारे capital में कम होता. This is what equation. Next, this is last year recalled question. Risk adjusted return on capital, it is applicable for above 7.5 crores. We have to calculate risk adjusted return on capital for loans above 7.5 crores, and accordingly we will do pricing. Last year recalled question, they asked what is the amount we consider for this RAROC, right? Above 7.5 crore. Below it is not applicable. Now we go for second one, policy and strategies. This is to avoid concentration risk. To avoid concentration risk, bank has come out with policy, certain guidelines. What are those guidelines? First one we see, this is not that much famous, that's why fastly I will tell what is this. Large borrower framework we call. Who is large borrower here? Specified borrower. They have given definition. Those who are enjoying 10,000 crores and above from banking system, they are called as specified borrowers. What Reserve Bank says, for these specified borrowers, don't give much loans. What is the quantum permissible? How much capital they are raising in a year? Suppose I will tell you example. This year, last year, one of our borrower has crossed 10,000 crores loan from our bank. 10,000 crores ho gaya uska. And usko normally we should not give. But if he approaches how much we can give, next year, what is the capital additional he is raising, sources from his side? What he is adding capital, usme aadha, 50% of funds mobilized from him during previous financial year. It is the eligible amount. But you see, this is not that much important. That's why I will not go for. Next one is important. This we will go. Large exposure framework. This is very important. Normally, one question every time they are asking. Right. Large exposure framework. It is to address concentration risk. What is this concentration risk? If bank sanctions loans to a particular person group, suppose Reliance is one group. Similarly, Adani is one group. If all your loans are sanctioned, majority of your loans are sanctioned to a particular group, if that group fails, bank also will fail. Similarly, if all majority of loans are given for a particular sector or particular industry sector, then if that industry fails, like bank also fails. Best example is your Global Trust Bank, wherein their exposure to share market loans very high. When share market collapsed, bank also collapsed. This is what we call concentration risk. Don't concentrate all your loans in one particular group persons or in one particular industry type. or one particular sector. So for this definition of large exposure, what is large exposure definition here? And all exposures to a bank to a counterparty means our borrower or a group, uska group. Wherever exposure to them is equal or above 10% of our capital, tier 1 capital. I will tell you, as per our yesterday's results, our tier 1 capital is 83,679 crores. So odd figure confusion we chhod denge, 80,000 we will take for calculation purpose. Our tier 1 capital is 80,000 crore. उसमें 10% क्या है? 80,000 में 10% is 8,000 crores. So 8,000 crores. So wherever bank has extended, our bank has extended 8,000 crores and above to any borrower or group. Say Reliance itself is one group, Adani Group itself is one group. उसको 8,000 crores से ज्यादा दिया तो we call that as a large exposure, right? More than 10% of our tier 1 capital दिया तो we call as a large exposure. So such loans, suppose Reliance Group comes, single party, that means only one group में एक ही corporate आता हमारे पास. How much maximum you can give? Not more than 20% of our tier 1 capital. Earlier example में tier 1 capital I told you 80,000 crores is tier 1 capital. So 20% उसमें आता 16,000 crore. So एक कारपोरेट को रिलायंस में भी रिलायंस होगा, अदानी होगा, वॉट एवर इट इज, 16,000 करोड़ से ज्यादा नहीं देना. दिस इज व्हाट एक्सपोजर टू सिंगल पार्टी मैक्सिमम कितना दे सकते, राइट? नेक्स्ट वन, इन एक्सेप्शनल केसेस बोर्ड ऑफ बैंक्स दे मे अलाउ एडिशनल 5%. दैट मीन्स विथ बोर्ड परमिशन अनदर 5% वी मे गो बियॉन्ड. सो 80,000 करोड़ में 25% आता 20,000 करोड़. So entire group, Reliance Group or Adani Group को 20,000 करोड़ से ज्यादा नहीं देना. This is what large exposure limits in case of single as well as group, right? Next, groups of connected counterparties. Entire Reliance Group 25% ceiling income, single group. Earlier I told you example 20,000 crores. Entire group को उससे ज्यादा नहीं होना. So single corporate 20% दिया, with board permission it can go beyond that. अच्छा, suppose Adani Group comes, single account only we are having. In that case you can go up to 20 plus 5% extra, 25 तक you can go. Other group comes, all group loans put together maximum 25% में 20,000 करोड़ से ज्यादा नहीं होना उनका सब loans मिलकर group का. Then whom we call as a group, that also we will discuss. Interbank exposure, here also 25%. Interbank, suppose दूसरा बैंक को देना, then maximum 25%. What is connected counterparties? यहाँ बोला था ना ग्रुप में connected counterparties means specific relationship or dependency such that if one account fails, other party also fails. Suppose Reliance में so many will be there, Reliance Power, Reliance etc. Industries etc. etc. If one account fails, most likely that other accounts also may fail. So if such a relationship is there, then we call it as connected counterparties, right? Next, group concern definition they are asking. This is recalled question several times. This one group definition they asked several times. They asked group definition में commonality of management and effective control on the management, it is called as group concern. Commonality of management, दोनों firms में management people are same, then we call it as a group concern. Or effective control, more than 50% management people are common. In such case also it is group concept we call. Okay, so first दोनों में एक ही है, इसीलिए second one I have not discussed there. So here we have seen individual corporate 20%. And with board permission another 5%. In case of group corporates, 25% of our tier 1 capital maximum. Interbank 25% we have seen. Now we are going for NBFCs. For single NBFC, 20% of our capital, that means 16,000 crores only we can give to a single NBFC. If group of NBFCs, then 25%, up to 20,000 crores, our example, we can go. And these figures normally it will be in credit wings, they will give maximum exposure to so and so this much like that. But here for exam purpose only, we are calculating percentages. Next, bank exposure to a single NBFC, which is gold loans company. In such case, maximum exposure is 7.5%. So here for NBFCs, three types: individual 20%, group 25%, and gold loan 7.5%. Next, GSIP to GSIP, it is 15%. Global systematically important banks. At present, 30 banks are there, GSIPs worldwide. Our Indian banks, no bank is included in these GSIPs. 30 banks are there, starting from first one is your Chase Bank. Yes. Next, DSIPs are there, domestic systematic important banks, DSIPs. DSIPs, there are 3 banks in India at present. One is State Bank of India, second one is ICICI Bank, and third one is HDFC. Only these three banks are in domestic systematically important banks. That means too big to fail. The exam, na, uska definition is systematically important bank ka matlab this is too big to fail. But with very big one, it cannot fail. That is what its definition, right? So GSIP to another GSIP 15% of capital, and non-GSIP to a GSIP 20% of capital. This is what exposure to GSIP, DSIPs, right? Next one, substantial exposure. Here, substantial, generally it will not touch substantial exposure, but as a prudential, just they have given, I will tell you in 1 minute what is the substantial exposure. Earlier example, I told you 10% usme kitna tha? 80,000 crores is our tier 1 capital, usme 10% is 8,000 crores. Wherever loans we have given to 8,000 crores and above, kitne loans diya hoga bank pura mein? Maybe some 10, 20, 30 loans hoga maximum. More than 8,000 crores. Hamara bank pura milkar, maybe 10, 20 or 30 loans will be there. All these loans, wherever 10% se exceed ho gaya, that means more than 8,000 crores, kitne logon ko hum finance diya, wo sab milkar, it should not be more than, total put together should not be more than 600%, means 6 times of our capital. 6 times kitna? 80,000 crores bola tha na, tier 1 capital, usme 6 times is 4,80,000. 4,80,000. So all bada loans jo bhi diya aapne, 8,000 and above loans, 8,000 crores and above loans, whatever it is given by our bank, it should not exceed 4,80,000 crores maximum. Normally it will not exceed, because our loans as on yesterday's figure is 9.24 crores. Say for understanding, we take 9 lakh crores, our advances. 9 lakh crores mein 40% you have to give for priority. So 9 lakhs mein 40%, 33.6. So usme 5.4. Now leftover is 5.4 lakh crores only. So if leftover itself is 5.4 lakh crores, then how you can give 4.8? Because usme all others also will come, like your staff loans se shuru karke, staff loans, gold loans, and retail lending, etc., etc. Normally it should not be. So this point they have given to avoid concentration risk. Bada loans zyada nahi dena. Bas. This is what substantial, over 3 to 4 only they ask this question. Lower level they have not touched. Bas. Next, this is important for 1 to 2, 2 to 3, etc. Credit exposure ceiling for individuals and non-corporate borrowers. Earlier corporates ko hum dekha 20% or 25%, that is norm for corporates. Non-corporates ko kya hai? For individuals other than schematic, other than business purpose, 30 crores maximum you can sanction to individuals. Maximum loan not for business purpose is 30 crores. If it is for business purpose, individuals ko maximum 75 crores. Non-corporates ko business ke liye 75 crores. Single entity with a trust or association, maximum 75 crores you can sanction. Next, single entity with constitution as society or trust. Society or trust, it is formed for educational institutions or hospitals. Yahan thoda priority, that is why they have considered more. Society or trust formed for educational institutions. You have seen so many engineering colleges, medical colleges, they are all societies formed for educational institutions. In such cases, or hospitals, bada hospitals, they are also trusts or societies for hospitals. So such cases, we can sanction. If it is a low risk, up to 350 crores, we can sanction. If it is a normal risk, up to 250 crores. If it is a moderate risk, up to 200 crores. If it is a high risk, it is 125 crores. Again, high risk at head office level only. New borrowers, right? For existing borrowers also, it will be ceiling. Next, if society or trust for other than education and hospitals, in such case again 100 crores only maximum amount. Other than hospitals and educational institutions, 100 crores maximum. Partnership and LLPs को maximum 125 crores. These are all ceiling for other than corporates. So mostly important, they are asking one taking from this. Next, RBI definition for unsecured exposure. Unsecured exposure means from the beginning. Ab initio means from the beginning, security is less than 10%. From the beginning, security is less than 10%. We have sanctioned 10 lakhs loan. Security is less than 1 lakh. In such case, we call it as unsecured. But don't confuse with our delegation of powers. Hamara delegation of powers may, if such thing is there, we call it as a clean loan. Secured loan, delegation of powers may, secured loans means it should be covered fully. 100% security by way of either primary security or collateral security. Primary security is nothing but whatever purchased out of our loan is primary security. Collateral security, it is not purchased from our finance. Party is already having or he has brought from some other's property he is giving. It is called as collateral security. Other than that, we have financed. So both put together, it should be 100%. Then only we call secured advance for delegation purpose. If it is less than 100%, we call it as a clean loan. Both put together, I am telling, right? Next, this is RBI definition. Ab initio 10% se kam hai to we call it as unsecured. This is also against shares, how much you can give. Yesterday, we have seen that in exam mein that our class mein margin 25% if it is in demat form. Margin we have seen. Now maximum quantum to individuals only. You have to keep in mind, against primary security of shares, loans can be given to individuals only, not for other than individuals like partnership, and your proprietorship also considered as individual actually. Partnership, companies, etc., LLP, etc., you should not sanction. Only for individuals we can sanction. But if they open against partnership again, proprietorship again, not in the name of firm, only in the name of individuals only, we can give, not in the name of firm. So maximum 20 lakh only we can sanction. And for IPOs, public offer, initial public offer, maximum 10 lakhs only we can give for subscribing. And ESOP, another scheme, employee stock option scheme. What is this employee stock option? Some companies may give shares to their employees. We call it as sweat equity. Sweat equity. That means instead of giving bonus or something, they give shares at lesser rate. It is called stock option scheme. So for subscribing to such ESOP, here also maximum 20 lakhs we can sanction. 90% of the loan means margin 10% only, not 25. For ESOP, 10% only margin. Maximum 20 lakhs common. IPO say 10 lakhs, other than IPO, maximum 20 lakhs only. Bus. This stock brokers ke liye, in last class I discussed, against property also we sanction OD, but 40% is margin. Otherwise, 50% margin for stock brokers. But for against property, 40% is margin. Next, other banks, ceiling to other banks. Ceiling in respect of exposure to other banks. Here, for public sector banks, as per large exposure framework, we have seen for interbank it is 25% maximum. So here also same thing will apply here. In case of cooperative banks, basing on their gradation matrix, maximum 25% of their total capital, we will sanction 25% of their total capital. But that is also in case their credit CRAR, capital to risk asset weighted ratio or capital adequacy ratio, it should not be less than 9% for tier 1 UCBs and not less than 12% for tier 2 to tier 4. These are only eligible. That means if they maintain adequate capital, then only we will sanction up to 25% of the total capital amount. This is for cooperative banks. So private sector banks go and non-prime foreign banks go. If their tangible net worth is 1,000 crores, then only we can sanction. That is also again up to 25%, right? Indian joint ventures, wholly owned subsidiaries abroad and overseas. Suppose some of our corporates, they want to acquire shares of their foreign subsidiaries, wholly owned subsidiaries or foreign companies. Their own, if they want to acquire, then in such cases, it is our quantum is limited to 20% of banks' unimpaired capital funds, maximum to corporates. So just like your individual corporate ka ceiling, this one, right? Next, operational process. So far, we have seen about policies. That is what at head office level, guidelines given for policies. Okay. So operational process and systems. First one is pricing of credit, loans pricing. How we will price? Above 25 crores ko grid methodology. That is external credit assessment, whatever it is there. Basing on that, we will do exposures above 25 crores, rate of interest we will fix. Pricing is nothing but fixing rate of interest. Next, above 2 crores up to 25 crores for Canada internal rating model. Basing on this, we will fix pricing rate of interest. 2 lakh to 2 crores internal ratings, small value model or manual model, whichever is applicable. Up to 20 SME, beyond 20 lakhs, it is manual model. So basing on that, we will fix rate of interest. Exposures above 2 lakh up to 2 crores for agriculture and allied activities ko scoring norms it is given. Basing on that, rate of interest will be fixed. Retail lending, it is schematic. Whatever they mention in that rate of interest, that will be. Exposure up to 2 lakhs, normally bank will advise from time to time, this is the rate of interest. So this is what pricing of credit. Next, concessions normally we are permitting. Up to what extent they are allowed. So if permitted normally, they co-terminus with original tenability. We are fixing tenability of 12 months. Normally concessions will end with 12 months. But extension is there. Up to first extension, yes, we can consider concessions. And second extension, no concession. Normal rate of interest. This is what concessions for rate of interest and charges. Next, accounts where rate of interest is permitted. Suppose concessional rate of interest we have permitted in the account. It has become NPA. In such cases, we apply applicable rate of interest plus 2%. From the date of NPA, we apply not concessional rate. What is applicable rate plus 2%? Because NPA ban gaya to penal interest 2% extra. So this rate we will apply. No concession if it becomes NPA. That is nothing but. Next, if external rating or internal rating is received, there is deterioration of rating. Suppose downgrade ho gaya, low risk se normal risk ban gaya ya normal se moderate ban gaya. In such cases, normally at the time of review, pricing will be changed at the time of review. Okay. And till review actually, what they say is, suppose one OCC renewed in last month. This month they submitted balance sheet. This month, basing on balance sheet, we have done risk rating. In this risk rating, one notch downgradation happened. One down. So normal say moderate risk ban gaya. It has become. So in such cases, next review will take place another 1 year. 1 year may already 2 months is over. So remaining 10 months is there. Till 10 months, don't wait. Till that time, they have given one big chart is given. 0.5% to 1.5% chart is given. So you basing on that charge, we have to charge this additional rate till next review. This recently it has come. Next, if downgradation of rating by 2 or more notches, that means standard say substandard ban gaya to 1 notch. Low risk say normal risk ban gaya to 1 notch, and it has become moderate risk. So 2 notches downgrade, moderate risk. Then in such cases, they have to give 25% additional collateral security within 6 months of downgradation. Otherwise, 1% additional interest till they give 25% additional. We have to charge. This is additional rate of interest in case of downgradation by 2 notches. Right? Next, concession in applicable rate of interest on account of upgradation, whether internal or external, whatever it is there, 7.5 crores and above, immediately you have to apply. This is what 756/2013. So immediately you have to apply for 7.50 crores and above, right? And suppose both ratings are there, internal as well as external. In such case, for upgradation, you consider only external rating for upgradation. Okay. Next, we go for Canara Bank Proposal Rating, CBPR. It is also credit scoring matrix applicable for 10 crores and above. Corporate loans, MSME, etc. Applicable for 10 crores and above, CBPR. Retail lending and restructured accounts, etc. exempted. So it is a pre-sanction exercise. Another one. Now ratings, mostly they may touch ratings. What is the gradation of risk? They may give simply what CBPR 3. What is gradation matching? It is medium risk. So CBPR 1 is low risk, 2 normal risk, 3 is medium risk, 4 is high risk, and CBPR 5 is very high, otherwise known as no-go rating also. No-go rating. Right? High risk ka parameters, whatever it is there, it is SMA 2 for past 3 months. High risk ke liye parameters. Interest coverage ratio less than 1. That means profits, surplus profits divided by interest, it is less than 1. CR, current ratio, less than 1. No fresh infusion of capital. So these are all guidelines for high risk, for classifying as high risk. Next, who will confirm? This CBPR rating, it is done. Who will confirm? Generally, confirmation by executive set or RM wing HO. Risk management wing at HO, because it is above 10 crores, RM wing HO will confirm. And up to CBPR 3 high to DM or AGM will confirm. And CBPR 4, that is high risk high to DGM will confirm. And another one, 50 crores and above CBPR may confirmed by individual authority at HO, it shall be placed before next higher authority for review. Because 50 crores and above subjected to review by next higher authority. And no-go ke liye, CBPR 5 aa gaya to no-go ke liye, once assessed by RM wing, such proposal shall be placed before CGM or GM level committee is there for approval or review at H2. So they have to confirm this is no-go account, because no-go means normally rejection only. Right? Next, risk rating policy. Normally risk rating, it is 1 year horizon. Probability of default we calculate. Next 1 year may whether it will become NPA. That is what probability 1 year ka horizon. Normally risk rating is reviewed annually. In case of listed companies, high risk borrowers review quarterly. Normally risk rating review yearly. Only in case of high risk wala, it is quarterly. Right. Present system for our Canara Bank mein, CIRM applicable for ratings above 2 crores, where CIRM hybrid model is not applicable. And last year they introduced one more model, 2 crores to 7.5 crores for SMEs, traders, agriculture and allied activities only, not for others. MSME, traders, agriculture and allied activities. 2 to 7.5 crores, above 2 crores to 7.5 crores, it is hybrid model, is CIRM hybrid model is applicable. Other than this SME, etc., for all other cities above 2 crores, CIRM model is applicable. CIRM above 2 crores. For hybrid eligible accounts, above 7.5 crores. Okay. Generally, they can do maximum amount, but above 25 crores, we say you go for external rating. So, we are considering this CIRM model strictly for up to 25 crores, but beyond 25 crores also they are doing, they can do. But for consideration normally, since above 25 crores, external rating also will be there. Basing on that, wherever both ratings are there, external rating we consider. Next. For accounts with exposure above 20 lakhs up to 2 crores, it is manual model. And above 2 lakhs to 20 lakhs, it is small value model. These are old concepts only, no change in this. And portfolio model is there up to 2 lakh rupees, and where there is no requirement of balance sheet, all small loans, etc., agriculture loans, where there is no requirement of balance sheet, then it is portfolio model, right? Next, last year one question has come, they have given. More than 25 crores turnover is there in a SME proposal. Under which rating model you will do CIRM? CIRM, where turnover is above 25 crores, it is large corporate module. Turnover below 25 crores, SME module. Traders, above 25 crores, again large trader. Below 25 crores turnover, small trader. NBFCs, it is NBFC module. What is the weightages given in risk category while doing risk rating? What is the weightage given for each parameter? Say industry risk. It is one of the sub-parameter of the risk weighting procedure. Industry risk, it is given 5% weightage is given. Where the new accounts 5%. New borrowers को 5%, existing वाले को भी 5%. Business and management risk 15% is for existing borrowers, 20% for new borrowers. Weightage. Financial risk 35% for existing, 40% for new borrowers. Security coverage risk 30% for existing, 35% for new. And conduct of account, since new borrowers, it will not be applicable. 15% is here. So it is 5% each they have given to other two, 3. 15, it is not applicable here. 5 added here, 5 added here, and 5 added here. Right? CRM hybrid, we have discussed this. Manual above 20 lakhs up to 2 crore. But here risk grades are CNR, manual model 1 to 8, and small value also similarly 1 to 8. CNR, SVM 1 to 8. Risk grades, 8 grades, 1 to 8. Again, mapping also we will see. Okay, facilities category added here. SVM 8, yeah, 8th one, I told you. 8th one, either manual model 8 or small value model 8, it is considered as default and it is called as SVM, small value model D or manual model D, last one. That means it has become NPA. Now I told you earlier rating, CNR 1, small value model 1, manual model 1, it is LR3, low risk 3. Similarly, manual model 2, SVM, small value model 2, normal risk. If 3 aa gaya to moderate risk 1. 4, if it comes 4, it is moderate risk 2. And if it comes 5, it is high risk 1. 6 is HR2, 7 HR3, and 8 is default. So this is what mapping, whether it is low risk. Suppose some it is given, what is SVM 3, small value model 3, under which risk category it comes, then you have to tell moderate risk 1. So mapping, it is also asking in exam. That is why just I have taken. Next, process and confirmation. This is also 1 to 2 or 2 to 3, they are touching this question. Process. Risk rating, who will initiate and who will check and who will approve. This is what process and confirmation. Normally, all credit proposals, they are subject to risk assessment by a team of independent of credit origination. That means whoever is getting this credit proposal, origination team means at branch level, unit level, whoever in credit department, it should be done by other. Mostly CMOA is there, they will give. That means who is not processing, they will give to that person. Next, as per delegation of powers, MCBs, LCBs, etc., branch level they will initiate, and at HO, RM wing, they will approve up to 35 crores. If it is DM or AGM, up to moderate risk, and if it is a high risk, it is DGM. In 35 to 250 crores, DGM. Beyond that, it is again CGM. Above 250 crores, it is approval by CGM or GM for all. In case of MSME Sulabs, they have to initiate internal risk rating in labs for loans of 2 crores to 35 crores. They will initiate, and at HO RM wing, they will review and approve. Who will again review and approve? Above 35 crores, ARM model initiation by CRRD. Yes. Section in charge of RM wing HO, he will review, and confirmation by DM, AGM, DGM, or RM wing HO. If above 35 crores, CARM model, initiation by CRRD wing HO and already confirmation by same wing only. Next, at circle offices, 2 to 35 crores RM section CO will initiate at CO. Again, at head office, they will verify and confirm. Next, mapping. CARM and external ratings. External rating AAA or AA or A. See, our CAMRM is 1 to 4. CNR, 1 to 5. It is called low risk. Suppose external rating up to this we call as low risk. BBB, it is normal risk. External rating may. Our CNR, it is 6. BB is moderate risk. And here CNR 8, 7 and 8. B and C high risk. It is CNR 9, 10, 11. D is default CNR D. This is what mapping. Okay, for high risk triggers, negative tangible net worth, the NPA with other banks, cash loss for past 3 years, auditors comment going concern. If 1 triggers is HR1, 2 triggers HR2, 3 or 4 triggers, it is HR3. So PD estimation 5 years, I told you. Loss given default it estimation 7 years normally. For retail, it is 5 years. Next one, validity of internal risk rating. It is annual oblizer. What is the validity is? It is 15 months actually. The credit risk rating, whatever we are doing, it is valid for 15 months normally or 18 months from the date of signing balance sheet. 15 months from the date of confirmation of rating or 18 months from the date of signing balance sheet. Basing on which balance sheet we have done this rating. So beyond 15 months or 18 months, as the case may be, there is no credit decision basing on this risk rating, right? Retail more than 70% are considered as investment grade. This external ratings may, what we have to do, one is short-term rating, second one is long-term ratings. Short-term ratings may, we have seen earlier, AAA or BBB or AAA, AA or A, BBB, BB, etc. That is for long-term ratings we call. Short-term ratings, it is A1 plus, A1, B, etc. It will come for short-term. So here long-term means up to 1 year it is short-term ratings. Beyond 1 year and OCC. OCC, though it is given for 12 months, it will be again renewed and continuously it will be there. That is why OCC or OD accounts normally we do for long-term ratings only. If it is less than 1 year, then only we do short-term ratings. So that is why mostly in our ratings we will not find A1 plus etc. Only AAA, AA or A or BBB or BB etc. we will find, because all are long-term ratings, right? Next, Basel approach may only risk weights it is given here. Risk weights wherever our claims means our loans actually on domestic sovereign. Domestic sovereign means central government or state government. And claims on RBI, DICGC, CGTMSC, wherever credit guarantee is given. Now, so many guarantee schemes are there. We are discussing in next session. Wherever such guarantees are there, till that guarantee, it is 0% risk weight. Beyond that only, suppose for example, 10 lakhs loan is given to northeastern area, 10 lakhs. So northeast area up to 50 lakhs, 80% CGTMSC coverage is there. For calculation of capital, what you have to do? Risk weight you have to do. So which risk it applies? 10 lakhs normally regulatory retail. Up to 7.5 crores, it is regulatory retail. We need not do any risk rating up to 7.5 for calculation of capital, not for other internal. So here 10 lakh is loan. CGTMSC coverage is 80%, 8 lakhs. So only 2 lakhs only we take exposure. 2 lakhs by 75% means it is 1.5 lakhs only. So you have to calculate capital on 1.5 lakhs only, not on entire 10 lakhs. This is what effect of your guarantees by central government or state government. Next, state government claims for 20% risk weight we have to apply. Foreign sovereigns again basing on AAA, AA, 0, BBB, etc. Okay, claims on public sector. Short-term ratings A1 plus 20, A1 30, A2 50, A3 100, normal risk. And A4 and below moderate risk. It is unrated 100% okay. Exposure on banks in India. Suppose we have given loan to a bank. So what is the risk weight we have to apply in such case? Where their CET, that means tier 1 capital plus capital conservation buffer, it is sufficient. That means as per RBI guideline, in such cases, 20% only risk weight. Otherwise, it will be more. So any bank, if it is meeting our RBI's capital adequacy criteria, in such case, 20% only risk weight. Otherwise, basing on rating of the bank, you have to charge. Normally, unrated corporates, asset finance companies, NBFC, IFCs, and they are having aggregate exposure more than 200 crore. If they are not doing risk rating, in such cases, risk weight is 150%. You have to keep in mind it is more than 200 crores. So up to 200 crores separately it is given. We will see that also, right? Exposure to CICs, core investment companies, that is 100% risk weight. This is recalled question, because though it is unrated, it is 100% risk weight. It is special one. Exposure to CICs, though unrated, it will be 100% risk weight only. Regulatory retail, just now I discussed, it is 75% risk weight. 3 criteria are there: turnover less than 50 crores or small product criteria. Granularity mein, single retail loan should not exceed 0.2% of the entire regulatory retail portfolio. Generally, it will not exceed, but it is given bus. And up to 7.5 crores, we call it as regulatory retail, and 75% risk weight would apply for this. This is important mostly. Of course, this is time is over here. Now it is running. Housing loans, very frequently they are asking for exams. What is the risk weight for this type housing loans? Housing loans sanctioned after 1/4/2023, basing on loan to value. Yesterday we have discussed loan to value. It is monitoring tool for all construction loans. Loan to value. That means outstanding liability divided by market value of security as on date. As on date outstanding liability divided by as on date value of security. If it is up to 80%, in this case, risk weight is 35%. And 80 to 90%, it is risk weight 50%. Up to 30 lakhs. And up to 75 lakhs again, it is risk weight, LTV is up to 80% only, it is applicable, and risk weight is 35%. Above 75 lakhs, where LTV up to 75%, risk weight is 50%. Only 3 types, 35% and 50%. Only 2 types of risk weights. So 35% is applicable only if LTV is up to 80%, then only 35% is applicable. If LTV is less than 80%, 80 to 90%, it is risk weight is 50%. Above 75 lakhs, 50%. Only 2 issues here. Standard asset provisioning, here it is 0.25%. Now, commercial real estate, already we have covered in last session. CRE RH को 75% risk weight and standard asset provisioning 0.75. Commercial real estate को 100% risk weight and 1% is standard asset provisioning. Right? NPS, where NPS where this provision, basing on provision, risk weight will be there. If provisions are less than 20%, 150% risk weight. If provisions are at least 20%, provisions are there, then 100%. NPA ban gaya to provisions will be there. Provisions in a substandard to secured 15%, unsecured 25%. And doubtful again, 25 or 40%, like that. In such cases, if provision is at least 20%, then risk weight is 150%. If provisions are at least 20%, then 100%. If provisions reach at least 50%, then risk weight is also 50%. So this is about NPS. And if NPS are secured by land and building, etc., then 100% risk weight may apply. Well, if provisions reaches 15%. Residential property, generally 100%. Right. Venture capital funds, this is a little, sometimes they are touching. Normally, highest risk weight is 150% generally. So that is for venture capital funds. Venture capital funds kya hai? Somebody is starting new venture, that is new type of business. Uska matlab industry mein ya, so far it is not, the type of business is not there. It is a innovation, we can say, new type. Somebody is starting new business. In such case, we call venture capital. Suppose if you sanction any loan, then venture capital we call. Such loans will attract risk weight. Not only this, suppose if you are investing in shares of a company which is started newly innovative company, that is also venture capital. Then in that case, it is 150%. Next, consumer credit, your personal loans, etc., 100%. Capital market exposure, 125%. Other than venture capital again. Venture capital, it is 150%. 9. Next, this also another important one, it has come. Claims on rated as well as unrated non-deposit taking systematically important NBFCs other than asset finance companies and IFCs, regardless of the amount of claim, they attract uniform risk weight of 100%. Earlier CICs we have seen, now this one, NBFC, ND, SSI. This is also 100%. Next, bank staff. Generally, if it is secured by terminal benefits, then 20%. Not secured by terminal benefits, 75% regulatory retail. This is for bank's own staff. Clearing Corporation of India, 20% risk weight. Basel recognized security is odd man out question they are asking. What is Basel recognized security? For calculation of capital, we reduce the security value. Basel recognized security में cash margin, bank deposit, gold jewelry, remaining all paper securities like your NSE, KVP, insurance, state government, central government securities, units of mutual funds, debt security, all paper securities plus gold jewelry, bank deposits and cash. These are only collaterals or securities for loans. For calculation of capital, our mortgage, land and building, plant and machinery, stocks, crops, etc., they are not considered as securities only for calculation of capital. Basel ka, not for other purposes. For our internal purpose, delegation of powers, etc., they are all securities. For calculation of capital only, it is not considered as security. What are our land and building, plant and machinery, stocks, etc.? They are not securities. Only these are securities for capital calculation. So to that extent, you can reduce. How we can reduce? Just I will tell you an example. You have sanctioned a clean loan like to a person, 5 lakh rupees, some personal loan, it is sanctioned 5 lakh rupees. But he has given LIC policies as security to the extent of 50%. So out of 5 lakhs, 2.5 lakhs ka security he has given. We call it as clean loan only because it is not fully covered. So in such a case, capital calculation may what happens? 5 lakhs is loan, 2.5 lakhs is insurance policy security. So it is considered a security by Basel. So we reduce loan amount minus security. 5 lakhs minus 2.5 security, it is 2.5 lakhs. So on 2.5 lakhs only, you have to calculate capital. So 2.5 lakhs means it is below 7.5 crore retail, regulatory retail, 75% risk weight. So 2.5 lakhs into 75%, it will come 1.75, something like that. On that, you maintain capital 11.5%, 9% to previous capital plus CCB 2.5%. So 11.5% capital on 1.75 only you calculate, not on full amount of 5 lakhs because it is secured by LIC to some extent. This is what calculation for capital purpose. For that purpose only, these are all securities recognized by Basel. Similarly, guarantees also recognized by Basel. Guarantee by central government, state government, scheduled banks, CGT, MSC. These are all our guarantees. Now new guarantees all. So these are all central government. Wherever these guarantees are there, to that extent, 0% is risk weight. That means earlier example we take 10 lakh rupees we have given loan to a lady. 85% for ladies, women beneficiaries, 85% coverage under CGT, MSC, women beneficiaries को. So CGMSC 85%, 10 lakhs liability में 85% is 8.5 lakhs. So 8.5 lakhs is covered by CGT MSC up to that percent 0%. That means for calculation of capital, your 10 lakhs loan will become 1.5 lakhs only because 8.5 lakhs is guaranteed by central government ka CGT MSC. So on 1.5 lakhs, you have to calculate again multiplied with risk weight 75% since it is regulatory retail. So 1.5 lakhs into 75%, it may be some 1.8 or 1.9, whatever it is. On that only 11.5% capital you calculate. This is how Basel recognized securities, if you have taken, our capital will be saved. This again, I will tell you in next session in MSME. While discussing MSME, you will understand how the effect of this, right? Housing loans, small value housing loans are there. Lower income group ka housing loans. For them, guarantee is given. Individuals up to 2 lakhs, 90% guarantee is there. 2 to 8 lakhs, 85% guarantee is there. Only for calculation of capital, this is taken. Similarly, for educational loans, up to 7.5 lakhs guarantee is there. So to that extent, if you are sanctioning 7.5 lakhs with the guarantee of this CGFSEL, then it will become 0%. You need not maintain capital on that 7.5 lakhs because entire 7.5 lakhs is covered by guarantee scheme of education loans. So this is about Basel calculation of capital. How? Now we go for collateral management, where one question they are touching about valuation of securities. Collateral management mein valuation of securities. Before tea time, I will finish up this. General guideline is that stock inspection, it should be carried out every month. General guideline. And in case of term loans, quarterly inspection. And in case of vehicles, yearly inspection. This is general guideline. Okay, collateral is risk weight. Already we have seen this. Zero haircut. Now we go for stock audit, applicability and periodicity. Stock audits. Valuation of, we call it as valuation of securities by valuers in bank panel. Normally, these valuers in bank panel, circle office, say GM, they will appoint this valuers in panel. At head office level, again, it will be taken by concerned beings. So valuation may, in case of low risk and normal risk accounts, 5 crores and above, applicability is 5 crores and above. Low risk and normal risk applicability. What is the stock audit or valuation? It is nothing but your stock valuation by chartered accountant. That's all. Stock audit or valuation by chartered accountant. So what is the applicability? Low risk and normal risk, 5 crores and above. If somebody is enjoying OD OCC against stocks and book debts, in that case, 5 crores and above low risk and normal risk account, once in a year it is subjected to stock audit. If it is a moderate risk or high risk, 1 crore and above, once in a year they have to do stock audit. Substandard and doubtful assets, 1 crore and above, once in 2 years stock audit is to be done. But in case of doubtful assets, 5 crore and above, once in a year. So this is what periodicity. Generally yearly, this one, periodicity. Only for substandard and doubtful below 5 crores, below 5 crores, then only it is once in 2 years. Otherwise, in all cases, it is yearly. Only cutoff limit, low risk and normal is 5 crores. For others, it is 1 crore. Doubtful assets also 5 crores. Next, stock audit is exempted from accounts covered under monitoring by agencies for specialized monitoring, ASM. In last CRM class, we have discussed this, ASMs. These are agencies identified by, again, IBA. They will maintain list. Out of that list, with 10 years experience, we will select and we entrust this work to stock audit, for stock audit. These are called as ASMs, agencies for specialized monitoring. Those who are registered with Indian Banks Association and having 10 years and above experience, to such people, we entrust this work, ASM work. And for eligibility is 250 crores and above exposure. Then we entrust quarterly. What they will do? Quarterly monitoring of cash flows, their duty. So how cash flows are there quarterly, whether expected level, production, everything is going or not, they see and submit as report. And for them, we give charges also. That next session and the monitoring tools I will discuss regarding charges. It is there. Next, if ASM is taking care accounts 250 crores and above, in such cases, this stock audit is not required because it is already taken by another chartered accountant. Then why another here stock audit? Already somebody is there, he is doing. So it is exempted, right? Next, closure of stock audit through SAS package by CO or HO. Next, valuation of fixed assets. Fixed assets of the borrower, land and building, plant and machinery, etc. Valuation generally once in 3 years. Next, housing loans, all variants, Canara mortgage, Canara rent, LRD, etc., etc. 50 lakhs and above every 5 years. This is second one. Normally, fixed assets valuation once in 3 years. Housing loans and housing related one, that is every 5 years. Next, valuation of properties 5 crore and above. 2 independent valuation reports. This is several times recalled question. Earlier 10 crores was their cut-off limit. And machinery, I thought 50 crores and above, still it is continuing. Exclusive machinery 50 crores and above, 2 valuation reports. At the time, even others also 50 crores was there. Gradually from 50 crores, it is reduced to 10 crore. Now it is reduced to 5 crores. So valuation of properties, land and building 5 crores and above, you have to obtain from 2 independent valuers. 2 independent valuers, 5 crores and above, it applies even in case of NPA, surface in AIGA, in that also it will come. 5 crores, if it is value is 5 crores, then 2 independent valuations. And another one, it comes Canara contractor, that is SME scheme, in that also 2 valuation reports will come, where your value is 2 crores and above. So 2 independent valuations. For agricultural advances again, 10 crores and above is 2 valuations, not 5 crores for agriculture, right? This is about 2 valuation reports, 5 crores and above for general advances. Next, valuation of only landed property without any superstructures, only landed property. In this case, acquisition cost as per registered sale deed. Normally within 1 year means sale deed registration value will be there. And then we call it as again guideline value also. That so acquisition cost as per registered sale deed may be considered as cost of land for this, if it is acquired within preceding 1 year. If it is more than 1 year, then 85% of fair market value. Because less than 3 years valuation, if it is doing means 85%. Now it is 33 months. That also we will see. So 85% of fair market value we will take if it is more than 1 year. Next, if property is acquired by way of gift deed or will, then no mention of amount. In such cases, if it is acquired in less than 12 months, so we go for sub-register office again, guideline value, whatever it is there, that value we will take. And beyond 12 months means normal guidelines is 85% of fair market value. So this is about valuation of only landed property without any superstructure. This is for general advances. Again, agriculture differs. That's right. Okay. Sugar stocks, of course, very rarely it has come. Unreleased stocks, levy sugar, it is levy price of government. And free sugar, if it is there, then average 3 months value we will take, not immediate present market value. So average 3 months value only we will take in case of free sugar. Agricultural lands. Valuation of agricultural lands, normally it is again once in 3 years. Poultry shed or dairy shed, farmhouse, etc. once in 3 years. If no structure is there, only open lands, in such case it is once in 5 years. Next, AEOs and AEO promoting managers, they can do valuation for loans up to, it is not value of property here, loans up to 30 lakhs, AEOs or AEO promoting managers, they can do valuation. Loans up to 20 lakhs, other than AEO managers, they can do. Next, 2 reports again, 2 empaneled values, 10 crores and above, it requires 2 valuation reports. Okay. Additional guidelines. Minimum gap between 2 valuations should be generally 3 years. It is general guideline. Suppose for any reason, if valuation is done in less than 3 years, now it is lesser than 33 months. Earlier it was less than 3 years they were mentioning. Now it says lesser than 36 months if it is valued. In such case, only 85% of the present value only to be taken, not full value. Normally once in 3 years they have to do valuation. If it is done in lesser than 3 years, that means they may be doing annually for enhancement. They say, sir, last year values, from last year till date value is increased. So you go for again valuation in such cases. If you do in lesser than 3 years frequency, then 85% of present value only to be taken. Right? This is about our first session. CRM policy. And we go next to, after tea break, we go for remaining. One is MSME policy and MSME schemes plus credit monitoring. Yeah, we will cover. You have to be here at least 10 minutes. Please take tea gap, and we will assemble. Now it is 11:35. So tea break 11:45. Yeah. 10 minutes. Yes, sir. So 10 minutes tea break we will take, sir. 11:45 again I will start sharp. 11:45 MSME policy I will start. Then MSME schemes and credit monitoring tools. We will finish by 1:30. Yeah. Yeah, we will, before going for this MSME policy, 2-3 doubts I have seen in our chart in the chart. I will clarify. Regarding 5 crores or 10 crores, this is 2 valuation reports. In our CRM policy, it is clearly mentioned 5 crores and above, 2 valuations in case of general advances. Whereas in agriculture, for 10 crores and above, 2 valuations, it is clearly mentioned. That is why I told this year it is changed from 10 crores to 5 crores for general advances. And earlier, very clearly, they were giving for machineries 50 crores and above, 2 valuations. And depreciation also, earlier it was given for land and building 5% depreciation per annum, and machinery 15% depreciation per annum, vehicles 20% depreciation per annum. It was given in our earlier policy, but this year those points it is not mentioned. Machinery 50 crores and above, 2 valuations, and this depreciations it is not mentioned. That is why I have not touched those points. Right, one. Next, regarding LCs, revocable LC and irrevocable LC, so clarification is requested. Revocable LC means changing or altering any terms and conditions by either buyer or seller. After issuing LC, any alteration of change terms and conditions, if it is allowed, then it is called revocable. Irrevocable LC may no question of changing or altering terms and conditions. Once LC issued means it is final. It will not be touched. That is what irrevocable. So in irrevocable, normally we prefer. Revocable, generally they don't accept. Your ECPDs also they don't accept revocable LCs. Only irrevocable LCs is acceptable. And LCs deal with only papers. They will not deal with goods. Even if borrower says, sir, I have not received my goods, don't pay amount to them. We are not bothered. We have to pay on due date. If documents are in order. If documents are not in order, you have to inform sender. That is what foreign person. You have to inform within 5 days of receiving the documents. So you have not informed anything within 5 days means on due days, we are supposed to make payment, though our borrower may object. Otherwise, bank reputation will be problem. This is about LCs briefly, right? Next, in MSME policy also, yeah, slides I will provide after class. Certainly, whatever I prepared, already I have shared with Krishnan sir. Again, I will share after this class, whatever I have taught today. Separate folder also I have kept for today's class. This is what folder of today's class. All I will provide after class. Next, MSME policy. Majority of these policy guidelines we have covered in number 1, priority sector. Already Ravi has covered, and number 2, in my previous policy, credit risk management policy, they have come general guidelines. Those points I will skip, and the remaining points I will cover for purpose of time saving. And wherever important is there, again I will discuss. No problem, right? Classification, it is over already. Last class and priority sector, it is over. Classification cut. Next one, turnover. Okay, 7 point. This is classification related. Loans up to startups 50 crores. It is priority. It is also come here. Here targets. Yeah, targets. Earlier, very frequently they asked these questions. These targets, Prime Minister's Task Force has recommended achieve 20% year-on-year growth in micro and small enterprises. 20% year-on-year. Here, medium is not mentioned. You have to keep in mind. 20% year-over-year growth in micro and small enterprises. Similarly, 10% annual growth in micro enterprise accounts, number of accounts. Every year, 10% growth in annual growth in number of accounts of micro enterprises. Only micro. Other two not included. And the second one, 60% of loans. Whatever we are giving to micro and small enterprises, this sector. Micro and small enterprises, if you have sanctioned 100 crores loans to micro and small means, in that 60% minimum, you have to give to micro only. This is to give more loans to micro enterprises. So out of total loans given to micro and small enterprises, 60% of them should go to micro enterprises. These three are targets. Since old, it is very frequently asking those. That is why. Next, up to 10 lakh rupees, all MSME loans, there is no question of collateral security. It is mandatory. You should not accept. You should not, even party is offering, then also you should not accept. That is guideline. Next, RBI asked at least one specialized branch in each district. That is MSME specialized branch. And wherever our all loans 60% or more are given for MSME, then we can classify it as a MSME branch, existing one also. This is next. Wing, we need not worry about structure, it is given. Sulabs ka only cut-off limit you have to see. Sulabs beyond 25 lakhs, loans beyond 25 lakhs or beyond branch powers. If branch powers are less than 25 lakhs. In such case, it should be, loan should be processed, everything should be done by MSME Sulab. Next, common application NF 998. This is also a recalled question 1 to 2. Common application for MSME 998. Online application, it is available in two. One is Canada MSME.in and second one canarabank.com. Online application they can submit. And a copy of NB 139. That is loan sanction register. Electronically you have to submit fortnightly through labs or OLTS. Controlling office. Next, rejection aina SC/ST customers, next higher authority, government sponsored schemes we have to record in the register so that it will be reviewed by controlling authorities during branch visit. MSME concurrence of next higher authority. Next, export credit rejection should be reported to MD and CO through concerned wing. And whatever rejections are there, they are to be recorded in NB 139 online. It will be reviewed by controlling authorities during branch visits. Time norms. Suppose if somebody is submitting application branch, you have to verify within 7 days and ask for any further clarifications or any details. If in next 7 days nothing is come, means you have to reject the application. So total 14 days for this one. And MSME is a general guideline. How many days? All these days only. Earlier also we have skipped this in our policy. How many days for sanctioning different type quantum of loans up to 5 lakhs and above 5 lakhs up to 25 lakhs, etc. We need not worry. Regarding collaterals, we go. Regarding collaterals, up to 10 lakhs, as I told, no collateral security, it is mandatory. Up to 25 lakhs, here, there is no collateral provided financials it is given by our bank. So ratios they have given. If they meet this, meet those ratios, then you need not take collateral security up to 25 lakhs and cover under CGTMSE. Next, waiver of CGTMSE cover for loans above 10 lakhs up to 200 crores. Now, though the limit is enhanced to 5 crores, in policy it is mentioned. That is why, again, guidelines are to be developed for 2 to 5 crores. So, till the time we take only for waiver. For waiver of CGTMSE up to 2 crores, minimum collateral comfort should be 75% of the loan amount. Right? Then only concerned authorities can waive collateral this CGTMSE coverage. Why it is to be waived? Some parties they are objecting for charges. CGTMSE you are facing. Otherwise, I have got securities. I will give security. Why I have to pay yearly some 1.5 2% like that? That objection has come. That is why this point. Next, delayed payments. I told already in MSME Act it has come. Delayed payments. If any small unit is supplying material, raw material to larger corporates, they may neglect payment to small units. In such case, small unit will suffer. To safeguard their interest, MSME Act has given a provision that they have to pay, corporates have to pay to small MSMEs within agreed time. If there is no agreement, maximum 45 days time is given. Within 45 days, they have to pay. If they don't pay within 45 days, penal interest 3 times bank rate compounded monthly, they have to pay to MSMEs. That is what guideline of MSME Act. And enabling mechanism also yesterday, that previous class I have discussed. While MSME Act, this point also mentioned. Enabling mechanism. Whenever we are sanctioning 10 crores and above, working capital limits to our borrowers, there you fix a sublimit towards repayment to small SMEs. If borrower says, sir, I am not taking any supplies material from small units, then you ensure and then permit. This is guideline. 10 crores and above Valeko. This is latest one, important for current exam. Udyam Assist Certificate. What is this certificate? Normally, for any benefits, priority sector benefits, etc., Udyam registration certificate, MSME people have to submit. Udyam registration. They have to go to portal, register, and then submit certificate. For registering with portal, they should have at least PAN plus GST registration numbers. If these don't, somebody is not having these two, that means small people, street vendors or small artisans, we call them as informal micro enterprises. They don't have any PAN card or PAN number, GST, nothing is there. To such people to avail priority sector benefits, government has come out with a new one that is called Udyam Assist Certificate. So for this separate platform is there, Udyam Assist platform. They have started, Ministry of MOSC, and then they have to register and get this Udyam Assist certificate. It is as good as Udyam registration certificate for all benefits, for availing benefits. So instead of Udyam registration certificate, which is available with PAN card and GST number, people can take Udyam Assist certificate. Those who don't have PAN, they can take Udyam Assist certificate simply through this portal and avail benefits. This is what Udyam Assist certificate, latest one. Now we come for important one. Credit guarantee schemes may Credit Guarantee Fund Trust for Micro and Small Enterprises, CGT MSC. Now recently, there are changes in this, and important for current exam, all changes we will discuss. Coverage now, credit facilities up to 500 lakhs, including retail and wholesale trade. Earlier retail was up to 1 crore only, they have given with 50% coverage. Now they made all are equal, only one only. There is no second type of category for coverage. So all are covered up to 5 crores, whatever it is earlier coverages are there. All up to 5 crores covered, including educational training institutions, etc. And wherever we are sanctioning without any collateral. Why the CGTMSC has come into existence means, I will tell you. Earlier, without collateral security, banks were not financing for small units. So this MSME finance, it was a little bit difficult because most of the people who start their self-employment ventures or small scale industries, they don't have collateral security. Hence, they were deprived of institutional benefits like bank loans. So in such a situation, government, the central government, with the help of CBOA, they have started. So they are telling banks that if somebody is not having collateral security, we will give guarantee and you sanction them loans without taking collateral security. If you take collateral security, we will not give guarantee. This is what their concept. So with this concept, CGTMSA has come into existence. Original share of 4:1 ratio actually, 80% by central government, 20% by CBOA contribution. Originally, it has come. So now it is going from 50 lakhs it started, now it went up to 5 crore rupees coverage. So loans eligibility is, if banks are sanctioning loans without collateral security, it can be covered under CGTMSE. Next, hybrid security. Hybrid security means party is having part amount security. Suppose bank is sanctioning only 5 crore rupees to a person. Out of 5 crores, party can provide 250 crores or 2 crores or 2.5 crores security out of 5 crores. So what CGTMSC says, you take that collateral security whichever available, 2 crores or 2.5 crores, whatever it is. Remaining uncovered or unsecured portion, collateral, unsecured by collateral, whatever remaining portion is there. In this example, 2 crores or 2.5 crores, whatever it is. That we will cover. It is called as hybrid security. Part of the amount is secured collaterally, remaining part is guaranteed by CGTMSE. And while charging charges also, what CGTMSE says, you need not pay charges on collateral covered portion. For example, 5 crores is loan, 2 crores is collateral security, 3 crores is CGTMSE coverage. You pay charges for 3 crores only, not on entire 5 crores. because other 2 crores is covered by collateral security. So here charges also, where whatever portion CGTMSE is covering, to that portion only you pay charges. And here one more guideline it is given. On collateral securities, whatever party has offered, CGTMSE will have second charge on those properties. So with this guideline, they have given guarantee, right? This is about hybrid security. Next, no stipulation of minimum loan under hybrid security. More than one bank is financing, there also they can cover. How we will come to know that other bank is also financing? In CGTMSE, there is a search option. You can search in that and ascertain. Okay. Next, information on total exposure of borrower and extents of coverage made available in trust nominal fee. Here you have to correct it is nominal fee, not 50, it is 10 rupees. Because it is old one, recent one, I have checked in CGTMSE website. It is 10 rupees for such, and bank will absorb generally. So this you have to correct it, 10 rupees only. Page number 4 may correction. Right, 10 rupees for such. Next, applying for guarantee cover. Anytime we can apply. Normally, what our bank guidelines says, CGTMSE guidelines are, in case of new loans, whatever you sanction in this quarter, you have to invariably cover by next end of quarter. This is what CGTMSE guideline. All loans sanctioned in this quarter should be covered by end of next quarter. But our bank says, whatever loans you sanction in this month, within 15 days from the sanction date, you have to cover immediately. Within 15 days, you have to sanction. This is you have to cover under CGTMSE. This is our bank guideline. Now, anytime during the tenure of loan means earlier uncovered accounts. And CGTMSE says from 2020 onwards, those loans which are uncovered, because this guideline is given due to COVID effect. COVID effect. So uncovered loans, whatever it is there, now you can cover those loans also, provided past 1 year, it is not in SMA2 status, and it is still standard asset. Activity is running, not closed. These 3 conditions, it is not restructured, not SMA2, and standard asset, activity is running. In such a case, you can cover now uncovered accounts also, right? Next, Udyam registration. Earlier I told you that by example may they have to compulsorily register. But here also, Udyam registration's number is compulsory for this coverage. Only exception given is PM Swanidhi scheme, where the 3 types we will cover that also. And CGSSD, this is subordinated debt scheme. That also we will cover in last page of this material, last page itself. This is there. Subordinated debt, that also we will cover. For these 2, Udyam registration is not compulsory. And for all other cases, Udyam registration number is mandatory. They have to register, take certificate. That in number in certificate they have to mention in this. Next, interest rate cap. Here also you have to correct, not exceeding 25% is old norm. Now what they say is, as per Reserve Bank guidelines, whatever rate charged as per RBI guidelines, this is eligible. So 25% cap also you have to change in this material. As per RBI guidelines, whatever charges, interest rate is charging, that loan is eligible. Earlier guideline, why this is kept, because if you are charging abnormal rate of interest and asking us to cover guarantee, they will not give. So now that norm is changed. As per RBI guidelines, we are charging, yes, it is eligible, you can cover, not 25%, right? Next, extent of coverage. Here so many changes are there, you have to take care. Extent of coverage for micro enterprises, up to 5 lakhs, 85% of coverage. It is old one only, there is no change, up to 5 lakhs. So beyond 5 lakhs, up to 5 crores, 75% coverage here. For micro enterprises, up to 5 lakhs, 85% coverage. And above 5 lakhs, up to 500 lakhs, 75% coverage. First one. Second one, units in northeastern region, including Sikkim, Jammu, Kashmir, and Ladakh. These 2 added, Jammu, Kashmir, and Ladakh added subsequently. So northeastern, Jammu, Kashmir, and Ladakh, Up to 50 lakhs, 80% coverage. Up to 50 lakhs. So you have to keep in mind, women beneficiaries, earlier they were in this category. Now it has gone to next category. Women beneficiaries has gone to 85% category. So 80% category may only Northeast states unit and Jammu Kashmir it is available. So here up to 50 lakh 80% coverage. Beyond 50 lakh again up to 500 lakh 75% coverage. Next, women enterprises, MSCs in aspirational districts. Aspirational district means government has identified few districts where they want to grow more SME units, maybe backward area or other problems. So government has given some intensives and identified them as aspirational districts where bankers are supposed to encourage more units, more finance. So those districts, aspirational districts, here are 85% coverage. ZED, zero defect, zero effect. This is all quality control ka ZED certificate. If that also we will discuss, it is there. So ZED certified units also 85% coverage. SC/ST beneficiaries and physically handicapped beneficiaries also 85%. Here total 85% out of 500 lakhs may 85%. That means 4.25 crores they will get back. 85% coverage means. Next, all others like retail trade and other eligibility borrowers, 75% of the amount in default. So these are all coverage different types. Important change is addition of Jammu Kashmir in 80% now, and women category it is gone to aspirational districts, etc. It is included, including Agniveers also here. Another one you have to add Agniveers. Recently government has started that recruitment of army, etc. people. They will serve there for 5 years. Afterwards, they call as Agniveers. And out of their selection, whatever it is there, some people they may observe permanently. Remaining people, they can avail finance and start their self-employment venture. So those people who served in army for 5 years, they are called as Agniveers. So to such people also, here it is given 85% coverage is given. Here you have to add Agniveers also in this category, right? Next, term loan, full term of loan, guarantee coverage is there. Working capital 5 years black, maximum 10 years nai, any number of blocks, this also you have to correct. Any number of blocks, every 5 years, it will go on continuously because OCC as far as unit is running, OCC will be continuously, it will be there. Every 5 years, renewal should be there with CGT MSc. This is what guideline. No maximum period, but renewal every 5 years for working capital. Because working capital first validity is for 5 years only. Term loan, full term, whether you are fixing 7 years, yes, 7 years covered. You are fixing for 10 years, 10 years covered. If you are fixing for 15 years also, 15 years they cover at a time. So this is about at a time coverage, right? Next one, any? Okay, we'll see. Regarding annual guarantee fee, AGF, these are also changes from this year onwards. AGF may up to 10 lakhs 0.37%, up to 50 lakhs it is 0.55, 50 lakhs to 1 crore 0.6%, and 100 to 200 1.2, 200 to 500 lakhs 1.35. Almost we can say reduced rate of AGF, annual guarantee fee. This is standard rate. On this premium it is there 15%, 30%, 50% and 70% premium. Of course, premium guidelines, it is not mentioned clearly. That is why it is not given here also. But two aspects it is given, how they will calculate premium. 15% premium calculation is given. 70% also it is given. We will see. It will come next point. So premium rates also you have to remember, they are asking. Next, every year, what CGT MSc do, their agent, they have appointed some agencies, they will assess our bank loan ka everything. That means up to what percentage they are covering, up to what percentage they are invoking, everything. So if invocations are more, in such case, additional premium they will charge. If invocations are less, that means it is a good monitoring is there, good control is there. In such cases, they give discount of 10% on standard rate. It is basing on external agencies assessment or internal assessment about bank. This is regarding bank. So on all loans covered by a particular bank, they will get 10% discounted rate if your claims rate is less. Right? Next, where banks MLS means banks with a high risk associated. That means if these external or internal agencies says these are all very high risk people, in such cases 70% premium. Risk premium is 70% on standard rate. That means earlier wherever you are charging 1.35%, is for 70% you have to add. So 0.60 into 70% means 0.42. So 1.02 you have to pay in this case. Like that 70% additional premium, it is applicable in case of high risk wala. This is last year recalled question. 15% where it will apply. Where 15% premium will apply if you exceed payout threshold limit. What is payout threshold limit? They have fixed twice the amount of your premium paid in a particular year, twice the amount of premium paid in a particular year, plus whatever claims you have settled. Total put together, they says it is threshold limit. So if you exceed that limit 2 times, our claims are exceeding that limit 2 times more than price in last 5 years. That means, suppose if your threshold claims are 100 crores, you have crossed 200 crores, that means 201 crores or 205 crores you have claimed. Such claims more than 3 times in last 5 years. That means very frequently you are claiming. In such case, premium of 15% is to be added. This is recalled question last year, right? Next, discounted rates. This they are giving. This is latest one, important for current year exam. Last year also it has come. And few they have added this year. Discounts. Women entrepreneurs, SC/ST borrowers, Agniveers, they would be given 10% discount on standard rate of fees. Number 1. Number 2, units in northeastern region, including Sikkim, Jammu, Kashmir. Here you have to add up to 50 lakhs only. Premium may 10% discount, not on full amount, because up to 50 lakhs for them coverage is 80%. Only for that quantum of loan. Wherever you have sanctioned up to 50 lakh rupees loan, for them 10% discount in premium, it is eligible. And MSCs in aspirational districts, I already discussed this. They would be given 10% discount on standard. And ZED certified, zero defect, zero effect certified, quality, good quality. Such MSCs will also get 10% discount in standard rate. Suppose somebody is following all these 4 categories: women entrepreneur, northeastern region staying, aspirational district, it is in that aspirational district they are there, and ZED certified. All 4 are there. In that case, they are eligible maximum 30% discount, not 40%. Each 10%, maximum discount is 30% allowed here. So this is about the discount rates for CGT MSc fees. Next, annual guarantee fee will be charged on outstanding liability as on 31st December in case of term loans. Whatever liability outstanding as on 31st, that they will charge on that liability. In case of working capital limit, normally for first year we pay an entire limit. And second year onwards, what is maximum availed peak limit? Last year, how much maximum they availed? On that peak limit availment means sometimes we may give more ad hoc also we might have given. So on that amount we have to take, not on sanction limit here. So maximum peak limit availed by them, that on that you have to calculate for working capital. In case of hybrid security, proportionate, already discussed this. And premium to be paid within 30 days of disbursement or 30 days of demand advice. Otherwise, for delay, you have to pay, what is that? 4% above bank rate of interest plus 15% premium on guarantee fee. 2 penalties for delayed payments. So any payment which is due to trust, if it is not paid within permissible period, you have to pay 4% above bank rate plus 15% premium on guarantee fee, extra rate you have to pay. Okay. Right. Next one. NPM marking within 15th of succeeding month. In CGTMS postal by end of next quarter. Here also just like coverage. If any account becomes NPA in this quarter, by next quarter end, you have to mark NPA. But our bank guideline 15th of succeeding month. Claim preferment, when you have to claim it within 3 years of NPA date or completion of lock-in period, whichever is later. Within 3 years of NPA date or completion of lock-in period. What is lock-in period? 18 months from the date of coverage, it is lock-in period. So if account has become NPA after 18 months lock-in period, then from NPA date, 3 years we will calculate. Suppose one account has become NPA during lock-in period of 18 months. That means within 1 year of coverage, it has become NPA. Then you have to wait till completion of lock-in period. From lock-in period completion, 3 years you have to wait, and within 3 years you have to claim. Calculation of 3 years is from completion of lock-in period. But our bank says within 180 days of NPA or completion of lock-in period, whichever is, and means within 180 days of completion of lock-in period or becoming NPA, whichever is later, you have to claim as per our bank. So don't wait for 3 years. Within 180 days, you claim. This is important current year. Waiver of legal action. Originally 50,000 was there, enhanced to 1 lakh, then 5 lakhs, now it is 10 lakh rupees. So what is this waiver action legal? Normally the condition for claiming CGT MSE claim is that you have to file suit in a court and then only you claim. That is the guideline. You have to file suit in claim and then you have to file suit in a court and then claim CGT MSE. But up to some extent, without filing suit, you can claim. So what is that extent? Now it is enhanced to 10 lakhs. That means up to 10 lakh rupees claim, you need not file case in court. Without filing case in court, you can claim CGT MSE up to 10 lakh rupees. If liability is 10 lakh rupees. But for waiver of legal action, this is called as waiver of legal action for the purpose of submitting claim. For this, at least AGM level authorities, bank may AGM level authorities, AGM, ROCAC and above authorities, they have to examine and take decision. This copy of decision, it is to be submitted to CGT MSE for claiming 10 lakh rupees without filing suit. Right? This is claim. Next, for these loans, 10 lakh up to 10 lakhs without filing suit, for these loans, CGT MSE has given 2 options. Generally, first CGT MSE, what they will do, immediately after submitting our claim, 75% of the claim amount, they will pay immediately within 30 days, they will pay in 75%. Remaining 25% of the amount, what CGT MSE says, you wait till 3 years from the date of decree, because normally suit filing you have to do. So after suit filing, you will get decree. So after decree, wait for 3 years and then claim your remaining 25%. Suppose if party borrower died, whereabouts not known, in such case, 3 years from the date of previous claim, you can submit second claim of 25%. This is general guideline. But for up to 10 lakh rupees, what CGT MSE says is, I will settle in single installment, but you reduce your claim by 15%. Suppose one account is eligible for 80% claim. You reduce 15% and we will pay 65%, because in 80% reduce 15%. Then it will become 65%. So 65% at a time we will pay. But bank has not opted this. Bank has not chosen this. Second chance, what is that? Just like normal. What is that normal? Now you take 75% and after 3 years, you claim remaining 25%. Since there is no legal action, after 3 years, we can claim this 25%. So bank has opted this normal channel only. This is about claim for up to 10 lakh rupees, two types. Right. Okay, these parameters it is given for covering CGTMSC without collateral security. All good parameters like current ratio, good 1.25, minimum contribution 30%, margin party car, debt equity ratio 2:1, DSCR 1.5. These are all good ratios, standard ratios. FACR 1.4 and above, good ratio. IRR 5% above, normal 4%, but here 5% above. Repayment up to 6 years. These are all conditions it is given for covering under CGTMSC up to 50 lakhs without taking collateral security. Right? Right. Next. Security hybrid. Now we need that. Sanctioning authority. If security is more than 50%, respective sanctioning authority, they can take decision for waiver of this CGTMSC, but all these conditions they have to meet. And the security is less than 50%, then next higher authority has to take decision, but parameters they have to take, right? Next, second type of guarantee, credit guarantee fund for micro units, CGFMU. CGMFU, it is managed by NCGTC, National Credit Guarantee Trust Company. National Credit Guarantee Trust Company. Of course, it is also set up by Government of India. Here, this covers borrowers under Mudra Yojana, Prime Minister PMMI, up to 10 lakh rupees without collateral. Next one, OD, Janadana Yojana accounts we are giving in a PMJDY, up to 10,000 rupees OD we will give. These loans also will be covered by CGFMU. Now, recent addition here, it is not mentioned here, recent addition. SHG, self-help groups above 10 lakhs up to 20 lakhs. They are also covered under this CGFMU. SHGs above 10 lakhs up to 20 lakhs, it is covered here. Next, for rate of interest, Shishu loans up to 50,000. Shishu up to 50,000 है ना मुद्रा में. Shishu, Kishore, Tarun up to 50,000 up to 5 lakhs and above 5 lakhs up to 10 lakhs. So not more than 12% rate of interest ceiling is there. We should not charge more than 12% for the Shishu loans. Then only they are eligible for coverage under CGFMU, right? So here not individual loans here coverage, it is portfolio basis. It will be done by head office level, right? Next one is Stand Up India scheme. It is for women beneficiaries and SC/ST beneficiaries, about 10 lakhs up to 100 lakhs scheme. It is also maintained by NCGTC. Coverage up to 50 lakhs, 80% coverage, above 50 lakhs, 50% coverage. So total 65 lakhs coverage is there. First 50 ko 80%, it is 40 lakhs. Next 50% it is 25 lakhs. Total it is 60. Yeah, 5 lakhs. Next, another one scheme, credit enhancement guarantee scheme for scheduled caste people. This is minimum loan amount 15 lakhs and maximum they have not prescribed, but it is covered by this separate guarantee scheme implemented by IFCA, Industrial Finance Corporation of India. So all these activities are eligible. ECGC already we have covered pre-shipment and post-shipment. Startups is covered by again NCGDC, identified by DPIT. Startups definition and loans we will see. In schemes it will come. Now, revival and rehabilitation of MSMEs. Just 1 minute, I will come back. 1 minute, I will take gap. Yes. So, regarding framework for revival and rehabilitation of MSMEs, here up to 25 crores, even COVID times also it is given, earlier also it was there, up to 25 crores, this rehabilitation or revival, it is there. That we will cover in next one also, it will come. All stressed accounts, normally it will be restructured in this committee approach for stress resolution. In stress resolution, restructuring or recall or any providing additional assistance, they will take care here. Only restructuring, 2-3 points for exam point of view, I will discuss here. Restructuring may, because last, yeah. Mostly in restructuring, these 3 questions, they are appearing. That is why I have taken only 3 points only. In case of restructuring, what happens is, suppose if any account, if it is eligible for restructuring, whatever overdue interest it is there, unrecovered interest from term loans and working capital, it will be culled out and separate, account will be opened. That is called funded interest term loan, FITL we call. It is only interest component. And in case of working capital loans, that is ODOCC, whatever overdue portion that is beyond drawing power, we call it as irregular portion. That irregular portion will be converted as working capital term loan, WCTL. And that will be at a lesser rate of interest. FITL may be with free of interest also, these two. And remaining in a term loan, it will be restructured and they will give 1 or 2 years repayment gap, and subsequently they have to pay installments. This is what it will be done in case of restructuring. And from 2014 onwards, Reserve Bank has told, whenever you are doing restructuring, you have to classify the account as NPA if it is a standard asset. That is why now it is not encouraged restructuring, CDR, etc. But as a special incentive, Reserve Bank is telling sometimes, like SME during COVID period, it is special permission is given. If you are doing restructuring of these MSME loans up to 25 crores, you need not classify them as NPAs. So that is special incentive given by RBI during COVID time, or any genuine reasons are there. Otherwise, it is to be classified as NPA. So in this, we will cover what is the specified period. Specified period means, earlier I told you, term loan is rephased or restructured. This is 1 year repayment gap, repayment holiday is there. After 1 year, you start repayment of this term loan. ODOCC, now it is running because overdue portion it is removed and kept separate. And term loan restructured. Next year, first installment will start. Next year, some time they will give. So from the start date, when installment starts, from that date onwards, up to 1 year further, the account should run without any overdues. 1 year from the date of next repayment, when repayment commences, from commencing date, 1 year it should run without overdues. That is called as satisfactory performance for 1 year from installment repayment start date. In this 1 year, no overdues are there. At the end of 1 year, account is in good condition without any overdues. Then we can classify and we can upgrade to standard asset category, because after restructuring it has become NPA, and 1 year from repayment start date it is showing good, no overdues are there. Now it is eligible for classifying as standard asset. It can be upgraded. So this 1 year from the date of commencement of repayment, it is called as specified period. During specified period, the account should show satisfactory performance. Then it can be upgraded to standard asset. So specified period, several times this question has come. 1 year from the date of commencement of next repayment installment after restructuring. It is called as specified period. Next, right of recompense. This is also frequently asked question. Right of recompense. What is this right of recompense? Bank is sacrificing some amount in the restructuring process. When bank is sacrificing, I told you FITL, funded interest term loan, all unrecovered interest is separately culled out and opened FITL. Mostly FITL, we will not charge any interest because it is interest portion. So there you are losing interest. Otherwise, if it is running account means on that interest, you will get again interest. or interest recovered means you will lend it somebody. So you are not recovering interest, you are not charging interest. There you are losing some amount, number one. Number two, installment now you are supposed to receive, but due to restructuring, you are receiving installment after 1 year or after 2 years. So money after 2 years or 1 year, today its value is lesser, maybe 90%. Here also you are losing something. So this amount, whatever bank has lost this amount, it is called as bank sacrifice. So whatever we have sacrificed in the process of restructuring, we can recover this from the party once the unit is running in profits. Once, that means 5 to 8 years, the unit will become viable within 5. Normally for small units, the units will become viable within 5 years and they have to repay in 8 to 10 years period. It is normal guideline. So after becoming viable, they are earning profits. All our loan is closed. After clearing loan, within next 2 years, they have to pay our sacrificed amount. Whether they are paying or not, but we are having a right on that amount. That right is called as right of recompense. Whatever we sacrificed in restructuring, we can recover from the party once the unit is running with profits. This is called right of recompense. And third one, promoter sacrifice. Here we are losing some amount. We are refacing installments and FITL created, WCTL created. But what is party stake here? Party has to bring some amount. What is his amount? Minimum 20% of bank sacrifice or 2% of the restructured debt, whichever is higher, party has to bring immediately upfront. This is party's contribution. So 3 points for exam purpose. Mostly they are asking. Units should become viable within 5 years. Repayment maximum 10 years for micro and small units and 7 to 10 years for medium enterprises. These are guidelines briefly for restructuring, because in COVID period, we have restructured some loans. That is why I have taken that now. Standby credit facilities for MSEs. Yesterday we have discussed in CRM policy also. Standby credit facilities up to 20% of sanction limit. It can be sanctioned to low risk and normal risk people. In case of exports, 10% of standby credit facilities. So it will be sanctioned and kept separately. Whenever they require, they can use. This is what standby credit facilities. It will be disbursed whenever cost overrun is there. Cost overrun. That means, suppose party is constructing some unit. Maybe the cost is escalated. Cost is more now because of time run. There is a delay. 6 months or 1 year delay in construction. Because of this delay, cost might have gone up. So this cost overrun, it will be taken care by for this out of this standby credit, right? Next, gold card scheme for exporters. This is last year recalled question. Standby credit here also. 20% for gold card exporters. Otherwise, for exporters, 10% only. But for gold card exporters, 20% over and above assessed limit we will give. He can avail that maximum 2 times only in a year for a period not exceeding 60 or 90 days. Just like ad hoc. Bas. Next, standby credit for capital expenditure. This I will cover in schemes, capital expenditure. Ad hoc credit facility, normally 2 occasions in a financial year, we will sanction. Maximum period of 90 days. 2% additional higher rate of interest we will charge. For exports, no additional rate of interest. For exports, no additional rates. Right? This is about ad hoc credit facility. Next, regarding appraisal guidelines. Regarding appraisal general guidelines, already we have covered in CRM policy. Fastly, I will go through. So, latest financials, 3 years you have to compare, number 1. In case of MSC, 2 years audited balance sheet you have to call for and check it through this website of ICI also. Next, ABS audited balance sheet for limits above 20 lakhs or turnover 100 lakhs and above, audited balance is compulsory. Financial statements to be verified with UDIN portal of ICI. And legal entity identifier, now 5 crores and above it is eligible, but time frame it is given 5 to 50 crores time is given. By 2025 April 30th, this should come 5 crores and above covered. Next, Above 5 crores limits, copy of passport of promoter or promoter director or guarantor, passport you have to obtain. If they are not having passport, you have to take undertaking letter from them. Next, CIR from CIBIL, Equifax, Experian, CRIF, Highmark, and CRR by external credit assessment wherever applicable means 25 crores and above 25 crores, external rating is compulsory. Next, key financials like turnover, net profit, leverage, tangible net worth, leverage, this is TOLS to TNW, liquidity, etc. of major group concerns or companies having above 30% of paid up capital. That means in group companies, wherever this main company has invested at least 30% of paid up capital. So all group companies key financials also you have to incorporate in the office note. This already we have discussed the same thing only. Next, project appraisal. This is also same. New units 5 crores and above. Existing LR and MR normal risk 10 crores and above. Project appraisal is compulsory. Moderate risk 5 crores and above. Project appraisal. This also earlier we have seen. Formats, all this we need not discuss deeply. All net means also only amount, basing on amount. Normally, while giving opinion letter, we will not mention exact exposure or exact net worth like that. Simply, we will mention fair, good, very good like that. So fair, if we mention there is worth is 10 to 25 lakhs. If you mention good, 25 to 1 crore. If it is a very good, 1 to 10 crores. Large means 10 to 25, very large, about 25 crores. Next, supply chain management. In supply chain management, what we do, I will tell you. One big corporate is there. To that corporate, one person, dealer or distributor, he is supplying material to that corporate. At the same time, the supplier dealer, he will also get raw material from other people, vendors we call vendors. So here 3 types are there. One is dealer who supplies material to corporate. Second one, supplying material to this dealer, second people. So whenever this fellow supplier is supplying to corporate, corporate will accept. If it is a good corporate, no problem. So such bills, number 1, vendors bills or dealers bills, we can discount online. This is what supply chain management. Okay, these are not that much for exam purpose. We will not. Assessment working capital already covered in policy. Both methods, turnover method, MPBF method, and cash budget. All 3 methods we have covered. Secured overdraft stock statement once in 6 months they have to submit. Next, other guidelines regarding working capital. It is valid for 12 months generally. Some exceptions are there. KCC, gold loan, staff account exemptions. Extension of tenability, maximum 6 months. At a time, maximum 3 months. If it is a high risk, it is only once 2 months. Already discussed this. Holding on operations also 6 months maximum, 3 months at a time. And working capital limits 50 crores and above. Quarterly cash flow statement we have to call for monitoring purpose. Term loans definition already we have seen. DCCO, date of commencement of commercial operations, realistically fixed at time. Okay, these are term loans ka bare mein. Annual review of term loans I will cover in monitoring tools. Prepayment penalty not applicable for SME loans. That is another guideline. Term loan sanctions are valid for 6 months. Validity also discussed earlier. Next, due diligence. This is another recalled question. Due diligence of CGT MSE covered accounts. First time borrowing above 10 lakhs with CGT MSE cover. Compulsorily you have to go for due diligence by external agencies are there. There, Brickworks, Acumen, Mera, Informatic, CRIF. I think recently Brickworks we have discontinued with this Brickworks. Remaining you can get from other 4 companies. They will submit report within 3 days. This is what due diligence report. Recalled question. Credit information companies, already main policy we have discussed this. In credit information companies, 4 are there, domestic. Sometimes they are asking CAR for 1 CAR you have to take or 2 CAR you have to take. Credit information companies may MSME up to 10 lakhs 1 CAR and above 10 lakhs it is 2 CARs. And next one, Above 10 lakhs up to 10 crores. This is another guideline. Above 10 lakhs up to 10 crores. Along with CIR, you have to take from CIBIL, CMR, you have to obtain CIR with CMR. So in package itself, it will come one report. If you are sanctioning above 10 lakhs, compulsorily we have to take one report from CIBIL with CMR. And second, you may take from any other credit information company. In labs package, already interface is there. So separately, you need not mention. It will come. CIC less than 650, high risk, next higher authority. Okay. CIBIL MSME rank. This is what CMR we told just now. Proposals. There are 1 to 10 rankings are there in CMR ranking. 1 is best rank and 10 is worst rank. Is applicable for about 10 lakhs up to 10 crores. And charges for this year, the charges enhanced. Earlier it was 900 rupees. Now it is 1000 rupees plus applicable taxes. Out of that, CIR charges 500. Additional charges for CMR is 500. So this current year change this one from 900 enhanced to 1000 rupees charges for CMR. Credit risk rating. Earlier today itself we have seen already these models. We need not again repeat this. ECA compulsory for above 25 crores. This also we have discussed today. Domestic credit rating agencies. CARE, CRISIL, Fitch, ICRA, and Acute Infomerics. So these 6 are domestic credit rating agencies, and 3 international: Fitch, Moody's, Standard & Poor's. These are international. So on 1 to 2, they asked a question. You identify which is not a domestic credit rating agency. So 3 domestic they have given, 1 international given. Odd man out you have to identify. So just remember, Fitch is there in both India as well as international. So here India Ratings Limited. That is why formal Fitch Ratings, it is India Ratings. And here it is mentioned as Fitch International. That you have to remember. Next, regarding external ratings, above 25 crores, we discussed already. Compulsorily, they have to obtain external credit rating. If they are not obtaining, then what is the penalty? So 25 crores to 100 crores loan, if they are not obtaining, then additional 0.25% interest you have to charge for non-obtention of external rating. This is 0.25, but SMEs, for SMEs it is 0.25. Other than SMEs, it is 0.5%. You have to keep in mind. Second one, about 10 crores, 100 crores, if they are not obtaining external credit rating for above 10 crore limit score, 0.5% you have to charge in case of SME units, and it is 1% for other than SME corporates go 1%. For SME, it is 0.5%. So 50% of charges only for SME here. Above 25 crores up to 100, if it is unrated, 0.25 additional rate, and above 100 crores score, 0.5% additional rate you have to charge. This is regarding additional rate of interest for non-obtention of external credit rating. But external credit rating, for delay only you have to collect. Waiver, nobody is having power other than ED and above authorities. Waiver of ECA, only ED and above authorities they are empowered, not below ED level. This is about ECA. Next, credit scoring model. Aggregate amount 2 crores. MSME being 60%, rejection okay. CBPR, this is another important one for exam purpose. Canara Bank proposal rating. So here, credit scoring matrix framework, proposal rating. Above 10 crores, it is applicable. First applicability, it is 10 crores and above applicability. Re-sanction exercise. So 34 parameters that are spread across 7 scoring sheets. In this CBPR 1 rating, it is low risk. CBPR 2 rating, normal risk. CBPR 3, medium risk. CBPR 4, it is high risk. CBPR 5, it is very high and no go. And who has to approve? Earlier we have seen CBPR Next, regarding takeover, norms already we have discussed in policy, same norms only. That is 3 years balance sheet you have to call for and analyze profits for 3 years continuously. It is not SMA2 during previous year. It is not a restructured one. And manufacturing unit at least 1 year old it should have. And date of commencement of commercial operations, at least more than 6 months ago, it has accomplished. That means for more than 6 months, it is earning cash. And satisfactory repayment track record for 6 months. And in the books of transfer bank, it is standard assets. Shifting from other bank not more than one occasion during the previous 5 years. And from last switch over, it should minimum 1 year, it should be there. And this can be exempted for those who were earlier with us, now gone. Suppose some party has gone from us for rate of interest, etc. There may be other bank may be giving some lesser rate, party might have gone. Again, they want to come back. In such case, this minimum 1 year clause not applicable for them. 1 year, 2 years gap in case of larger corporates. For MSME, BB or better shall only be taken over. In case of other than SME, triple B, that means normal risk only we will take. Low risk, normal risk, up to normal risk only we will take. Whereas for SME, BB means it is moderate risk. For that accounts also eligible for takeover. Next, 2-year audited financials of corporates to be verified with ROC. This is general guideline. Current ratio 1.33 or 1.25 general norm. But this can be relaxed up to 1. This is recalled question. For SME takeover, current ratio can be relaxed up to 1. It is relaxed, including 1. Debt equity ratio 3:1 is permitted. Normally 2:1, up to 3:1 also permitted. Term loan part sheet 1 year. Working capital to 6 months. You have to call for to verify. And time overrun and cost overrun over 15%. It is takeover to be avoided. What is time overrun? Within 3 years, the unit everything construction should completed and commencement of commercial operations should commence. So within 3 years, everything is to be completed, but still some pending is there. It is taking 4 years. 4 years means there is time overrun of 25%. It is not eligible because exceeded 50%. Similarly, project cost is 10 crores, but by the time completed, it has become 13 crores. That means 30% enhancement cost overrun. That is also not to be taken over because it is exceeding 15% now, right? Dilution of security not to be encouraged. We will not take. That means security, earlier bank he has given some 10 crore security. Now they are telling, sir, I will give only 6 crores or 7 crores or 8 crores. No question. Whatever it is given there, they have to give. Any substitution is at least it should have equal amount of released security. That is why there should not be dilution of security. Whatever security comfort is there with previous bank, it should continue. So here with enhancement, now with enhancement, security coverage including land and building, NSC, KVP, term deposit, etc., not less than 50% of exposure. So these are all good securities we call. Good securities should be minimum 50% of exposure. Then only with enhancement it is permissible. If enhancement is more than 25% of existing limits, sanctioned by next higher authority. But if enhancement is for expansion, in such case, same authority they can sanction. Enhancement more than 25% for expansion, same authority. Without expansion, next higher authority. Right? Stock audit, normally it is a pre-releasing condition for takeover. Stock audit. Up to 10 crores, stock audit can be waived provided previous bank stock audit report is there, not more than 6 months old. And up to 3 crores, more than 6 months old report also we will take. But in both cases, the condition is previous 3 months stock statement party has to bring from the previous bank and we have to verify this previous 3 months stock. These are conditions for waiver of stock audit. Normally it is compulsory, but we can waive in 2 occasions. Up to 3 crore, they have to produce more than 6 months old stock audit, even whether it is less than 6 months or more than 6 months, no problem. Up to 3 crores, it can be waived provided they are submitting stock audit report from previous bank. and up to 10 crore haito, in that case, previous bank stock audit should not be more than 6 months old. Then only we will accept. Okay. Next, digital lending. These are disbursement, etc., done by digital people. PSB loans in 59 minutes. Here, loans up to 5 crores. What are all the loans under this is eligible? One, working capital or term loan under Mudra. Mudra means up to 10 lakhs. Working capital term loan from 10 lakhs to 100 lakhs. Working capital or term loan new and renewal above 100 lakhs to 500 lakhs. These loans they can submit through online, that is in this portal, PSB 59 minutes portal. Within 7 to 8 working days, bank has to take decision and disperse if they are eligible. For this, tie up with fintech companies, their company's name is there, basics, sub KI transactions, etc. Next, eligible MSME proposals up to 10 lakhs only. Tie up with fintech companies. What these fintech companies will do is they do all that inquiring about party and bringing loan papers, etc. Everything they will do. In such cases, they are sourcing up eligible MSME proposals up to 10 lakhs. It is eligible sourcing through outside agency. And obtain application other documents they will obtain. Conduct KYC due diligence also these people will do. But loans up to 10 lakhs outsourcing permissible. Type fintech companies. MSME Sugam is one where everything is done through these people. And even STP mechanism, that also it is there, we will discuss. MSME Sugam through STP, it is being done now. TREDS, it is nothing but online discounting of bills raised by MSMEs. Earlier we have seen supply chain, similar to that here also. Some SME has supplied material to corporates and they raise bills online. These bills can be discounted through this platform. That is what TRE, Trade Receivables Discounting System. So here tenor up to 180 days bills we can discount online. Co-lending model, two models with NBFCs we have discussed in main one. 80% they can transfer to us by keeping 20% with that NBFC. So two types here. CLM, co-lending model LAP is one, where up to 10 crores loans they will source NBFCs, repayment up to 10 years, 3 months moratorium, 20% margin. And second is CLM Samarth. This is second type, up to 10 lakhs. These two types of loans, they are sanctioned by NBFCs. After sanctioning and disbursal, 80% of amount is transferred to us. Here, they disburse first 100% and 80% they assign, they transfer to us in the form of assignment agreement. This they will execute NBFC and transfer 80% by retaining 20% with them. So here only thing is 80-20 concept for co-lending scheme. And all these transactions are routing through escrow account. End-to-end digitization of Shishu Mudra loans. Shishu Mudra loans up to 50,000 through STP mechanism, straight through processing. Next, regarding Janasamarth portal. Janasamarth portal, it is Ministry of Finance, it has conceptualized. So all credit linked schemes like government schemes like Pradhana Mantri Mudra Yojana, Weavers Mudra, Stand Up India, NULM, National Urban Livelihood Mission. All these are through Janasamarth portal. That means borrowers can apply through Janasamarth portal, and our guideline is that branches should not reject applications received through Janasamarth portal. Only next higher authority has to reject. So it is to be processed. Account aggregator, this is another concept, it has come recently. What this aggregator will do, they collect information from information providers. Suppose some corporate is there. That corporate information they will collect, just like credit information companies, those companies, credit information companies, just like that they will collect information from corporates. And this information will be given to financial information users, nothing but financials, banks. So they collect information from corporates and give information to banks. So they act as a mediator, aggregator. Here they take consent from borrowers, that corporate customers. for giving information to banks. This is what consented information providing. Consented sharing of information. So aggregator concept, recently it has come. Account aggregators. PM Mudra. Shishu up to 50 loans. Okay, PM government sponsored schemes, it might have covered. I will not go through deeply through Mudra loans. CGFMU. Credit Guarantee Fund for Micro Units. Stand Up India scheme, already discussed this. Street vendors Atmanirbhar Nidhi, also government sponsored scheme. Working capital demand loan up to 10,000 payable in 1 year, first tranche. Second tranche may 15 to 20,000, second tranche. And third tranche, now they are eligible. Those who have cleared second tranche, now they are eligible up to 30,000 rupees, 30,000 to 50,000 rupees, they are eligible now. But for availing this third tranche, second tranche loan should have been closed. Whatever they have availed up to 20,000, it should have been closed. Then only they can avail this third scheme. Here only thing is interest subsidy they will get at the rate of 7% for all these first tranche, second tranche and third tranche loans. This is about PM Swanidhi scheme. NULM already covered in government sponsored one, up to 2 lakh rupees individuals and groups up to 10 lakh rupees, and they will get interest subvention. Whatever charged between 7% and actual rate of interest charge, the difference they will get as interest subvention. For prompt payment, women SHGs, 3% additional interest subvention. PM EGP, two schemes, that is former one and next second loan also. First one 50 lakhs and 20 lakhs, 50 lakhs for manufacturing and 20 lakhs for service sector. And first loans, subsidy 35% in rural and 25% in urban. Second loan up to 1 crore for manufacturing and up to 1 crore for manufacturing, up to 25 lakhs for service sector. Here subsidy is 15% subsidy, 20% in case of northeastern and hill areas. This is about PM EGP. Next, Weavers Mudra. Earlier artisan credit card was there. Now it is converted as Weavers Mudra scheme. Up to 2 lakh rupees finance can be sanctioned here. Within that again, term loan up to maximum 50,000 and the remaining is working capital. So maximum limit is 2 lakh rupees. What is margin money assistant here? 20% of the project cost with the maximum 10,000 rupees per borrower. It is margin money. Apart from that, again, they will get interest subvention also. The interest subvention is actual interest charged and 6%. What is the difference between beyond 6%, whatever we are charging, that they will get as interest subvention, but with cap of 7%. That means subvention maximum 7% only permissible. And maximum period 3 years, they will give this subvention. Similarly, one-time guarantee fee and annual service fee, it will be paid by government only up to 3 years period. So same artisan credit card, whatever guidelines are there, same guidelines here also. Only changes, they changed the name as Weavers Mudra, artisan credit card. Partial risk sharing facility. It is in some municipal corporations or somewhere, somebody is installing energy saving equipment, energy efficiency projects we call. Energy saving equipments like solar energy, etc. To such units, loan can be given. Here, guarantee up to 75% it is available. It is only here, 75% guarantee for energy saving projects. Next, credit linked capital subsidy scheme. Credit limits, earlier TUFs, etc. was there. Now only one scheme, credit linked capital subsidy scheme. Here, eligibility is units up to 100 lakh. And what is the benefit here? 15% of the project cost with maximum 15 lakhs is capital subsidy given by government. And if SC/ST beneficiaries go another 10% extra, that is called as special credit linked capital subsidy scheme, where apart from 15% normal, they will get 10% additional subsidy. That means for 100 lakhs, they will get 25 lakhs subsidy. This is CLCSS scheme. Zero effect, zero defect. This earlier we have discussed simply, but it is quality, good quality. It is indication that it is a their produce is good quality. This is what zero effect, zero defect ka. So whatever these units, they can take this ZED certificate and they categorize it three types. One is bronze, second one is silver, third one is gold. Basing on their marks, they have given separately. Basing on scoring, they are classified into three categories: bronze, silver, and gold. They are eligible for interest concession and also service charges concession. Basing on risk rating, if it is a low risk polar, then concession 0.1% for bronze, 0.25% silver, 0.5% for gold. Same rate for rate of interest and also processing charges. So if it is a normal rating, in such case 0.1%, 0.2 and 0.3. It is bronze, silver and gold respectively. And moderate risk के लिए only for silver and gold eligible, bronze is not eligible, 0.1% for silver, 0.25% for gold, and BB and below, it is not eligible, no concessions. So this is about ZED, zero effect, zero defect, right? Now we go for last one, subordinated debt. Subordinated debt. What is the subordinated debt scheme means? It is launched by CGT MSc. It is called as distressed asset fund or subordinated debt for stressed MSMEs. So during COVID period, if stress is there in the account, MSME accounts, so such accounts, this scheme is applicable. So what happens here? While restructuring or providing any additional benefits, party has to bring some margin. Earlier we have seen 20% of bank sacrifice or 2% of the total debt they have to bring. Like that, they have to bring their equity or capital. If they don't have equity or capital, they will lose whatever special incentives are there, they will lose. So to safeguard such people who cannot provide their own capital or equity for restructuring, etc., for them loan is given. Normally we will not, okay, normally we will not give loan for capital acquisition. That means party has to bring 25% capital from them. Out of that, at least 50% should be own capital. Remaining 50% they can borrow as long-term sources, as outside borrowings. So here that 50% nobody is giving outside, we will give that finance. Otherwise, it is not eligible. We will not finance for capital. Only it is a special scheme. Here we will give, but not in the form of capital. We will give in the form of clean loan. Here, what is the quantum? Maximum 75 lakhs or 50% of equity requirement. Because the guideline is that party's own money should be 50% in margin and 50% they can raise outside. Same norm here. Maximum 50% of his requirement we will give with maximum 75 lakhs. Here repayment is 10 years. First 7 years they need not repay, only interest they have to pay. Remaining 3 years they have to repay principal in installments. This is the scheme, distressed asset fund, subordinate debt. Here the coverage of CGT MSc is 90% of loan is covered by CGT MSc. Only 10% party has to bear. And the guarantee fee is 1.5% per annum on the guaranteed amount outstanding basis. It will be paid by borrower. This is about distressed asset fund scheme, subordinated debt car. It is given as a clean loan, right? Personal loan, clean loan, personal loan, because we are not supposed to sanction for his own equity. For margin, we will not give, right? Okay. Next. So these two COVID schemes, we need not worry. With this, actually, we go for two aspects are there pending within this time. We will try to finish. First one, monitoring tools, we will go through. Then, after monitoring tools, we go for MSME schemes also. So, a little fast, we will go through monitoring tools. First one, review of credit sanctions made by each authority, it will be reviewed by next higher authority. So here, PRR 20A, D, you have seen NB 139, all other loans other than retail and agriculture. NB 140, it is agriculture loans. NB 179, retail loans. NB 117, it is for government sponsored schemes. Right? So, number one. Number two, all sanctions up to 5 lakhs, fund-based and non-fund-based, and up to 6 lakhs SHGs, review on consolidation basis. That means RO will go through online. Now everything will be submitted online. RO will verify on consolidation basis. You need not send individual credit reports to the in respect of these accounts. So cutoff limit is 5 lakhs other loans, 6 lakhs SHG. Beyond this, copy of loan application we have to forward to RO for review before 7th of succeeding month. So here recalled question is, what is cutoff limit for submitting loan applications to next higher authority for review by branches here? By branches up to 5 lakhs or 6 lakhs. Number one. Next, RAH sanctions online review in labs package by RO exempted for personal loans up to 5 lakhs. Okay. This is about next. CO head CAC sanctions to HO, they have to send fortnightly. CAC, circle office sanctions to HO fortnightly. Within 7 days, they have to submit from the end of fortnight. At head office level, all sanctions of GM or CGM, HO, CAC, they should be reported to CAM wing every fortnight for review. Retail loans of 5 crores and above, which are backed by mortgage, pre-release audit is to be conducted. We will discuss that pre-release audit. VSLs to be placed to RO head by basing branch. Review of taken over accounts. Normally, taken over accounts, first 6 months, first half yearly review should be there for first 1 year and then normal review. Normally, review process, it should be completed within 30 days and any observations are there in that, they have to close within another 30 days. This is first one, review. Next, pre-release audit. This pre-release audit, why it has come? Because in some cases, branches have disbursed without taking full documentation. Then some problem has come. So bank has introduced this pre-release audit mainly to check whether documentation is completed in all respects or not. That is the main intention of pre-release audit. So applicability here is 3 crores and above, it is applicable. And retail lending loans 5 crores and above backed by mortgage, then only pre-release audit for retail lending loans. So the cutoff limit is 3 crores and above. For retail lending, 5 crores and above backed by mortgage. In case of ad hoc limits, then if it crosses 3 crores, pre-release audit is applicable. Then enforceability certificate to be obtained from panel advocate other than who had given LSR. In pre-release audit, this is enforceability certificate also to be obtained, right? And remuneration to panel advocate for conducting legal audit or enforceability certificate is minimum 1,000 rupees and maximum 10,000 plus GST per mortgage per borrower account. Debit to GC. And pre-release audit is to be conducted by scale 4 and above from nearest branch or office. Here what they check? Documentation, collection of applicable charges, CERSAI registration, they will verify. As I told you, mainly documentation and collection of applicable charges. That is processing charge, documentation charge, whether collected or not, they will check. And pre-release audit is to be completed within 48 hours from obtention of documentation. And no authority is empowered to permit waiver of pre-release audit. This is second monitoring tool. And third one is credit audit. Credit audit. The intention here, pre-release audit for check mainly for documentation. Credit audit mainly for post-sanction terms and conditions, whether they have met or not, and how the account is moving, because credit audit is conducted after 3 months and before 6 months from the date of sanction, it will be conducted. That is why they see account operations also. So here cutoff limit is 3 crores and above. Now, first one, Second is within 3 to 6 months from the date of first disbursement, they have to conduct. And CO to allot at least 3 crore accounts or less than 3 crores accounts also, CO will allot randomly up to maximum 5% of eligible accounts. Next, if facilities are permitted frequently, in a year 3-4 times some enhancement is there. In that case, maximum 2 credit audits are sufficient. And gap 6 months from previous credit audit. Limits below 5 crores credit audit by internal staff or external auditors, because external people also will conduct. And 5 crores and above audit by external auditors only, credit audit. Maximum fee to external auditor 6,000 rupees. And closure of credit audit, generally within 3 months it is to be closed. Suppose joint documentation or second charge creation pending, etc. In such case, maximum 6 months. So this is briefly about credit audit, another monitoring tool. Stock and receivable audit, already we have seen in earlier one, stock audit over. Case of stock audit, in case of takeover within 3 months, normally it is to be conducted, and waiver also, it is, we have seen. Credit review and monitoring format, CRMF. Earlier, CMF was there, and CMF come MTR was there. MTR when discontinued, they started CMF come MTR. That is half yearly. It has to be prepared. CMF come MTR. Quarterly CMF will be there. Now both are merged as CRMF, credit review and monitoring format. Here also fund-based and non-fund-based exposure 3 crores and above applicable for low risk, normal risk and moderate risk. In case of high risk, 1 crore and above applicability. Next, periodicity quarterly. That is 30th June, 30th September, 31st December and 31st March. It is to be submitted within 10 days from due date. Next, if sanction, renewal or ad hoc takes place in any of the above mentioned months, no CRMF. That means in any particular month, renewal of limits had taken place, then you need not submit CRMF for that particular quarter, because already in renewal proposal, everything is incorporated, right? Next, if annual review of term loans have done, yearly once you are doing, then also no CMRF during that particular quarter, because in annual review of term loans, all aspects are taken care, hence no separate CMRF is required. Next, CMRF duly signed by branch head, it has to be uploaded in LCA module within 10 days. CMRF for SMA1 and SMA2 accounts with liability 25 crores and above, a copy is to be endorsed to SAMWING HO also for the monitoring, right? ASM, agencies for specialized monitoring. Already I have discussed this. It is exposure of 250 crores and above by external people. IBA has identified these people. From them we will select and we will entrust this duty. And they do what they do. We give contract yearly and quarterly they do this monitoring. Fees for them up to 5 lakh rupees for exposure up to 5 crores. That means if the exposure is up to 5 crores, maximum amount up to 5 lakhs we will pay plus GST. If exposure is above 500 crores, then 8 lakhs plus GST. Up to 8 lakhs plus GST. It need not be exactly 8 lakhs, it may be less also. That is why it is mentioned up to 8 lakhs amount, right? And it is quarterly payable, because monitoring is quarterly. Fee also within that amount they pay 1/4 each quarter. Review by CO head, review committee and forward to CAMWING HO. CAMWING HO will appoint ASM for IBA list with more than 10 years experience. Already we have discussed. Annual review of term loans. It is applicable. Standalone term loans means no working capital limits are there. Only term loan party is enjoying. In such case, these loans sanctioned by CO head, CAC and above, yearly it is to be done. Annual review. Standard restructure and NPA accounts not marked for recovery, they are eligible. If borrower is enjoying working capital and term loans, in that case, whenever working capital limits are renewed, at that time, term loan review also will take place. No separate review. Retail loans up to 5 crores, sanctioned by CO head, CAC, exempted. Retail loans up to 5 crores, exempted for annual review. Normally, all CO head, CAC accounts are to be done, but retail loans up to 5 crores sanctioned by CO head, CAC, they are exempted. When annual review of term loan takes place, CRMF also, it is not applicable for that quarter. Next, one-time review by CAM wing after 6 months from sanction, thereafter yearly review as applicable. This is applicability of this. CERSAI. To proceed under Surface E, it is mandatory to register charge under CERSAI. Next, charge creation. What are all eligibility? Mortgage, hypothecation on movable assets, intangibles, agreement during construction also eligible. All these to be registered with CERSAI immediately after loan creation in the account. On the same day of loan opening in the account, on the same day of loan opening, CERSAI registration and ID updation is to be done. Online search is available in CERSAI with a fee of 10 rupees per search. It is observed by bank, CERSAI search. And fee addition of security interest. For addition of security interest, fee is 250 rupees plus GST, 18% GST, up to 10 lakhs. Above 10 lakhs, 500 rupees plus GST. This is fee payable to CERSAI for addition of security. Next, modification of security co 100 rupees plus GST for loan up to 10 lakhs, 150 plus GST for loans above 10 lakhs. Satisfaction of security interest, nil charges. Online search observed by bank only. Right? BAM 73 option in CBS FCR for entering CERSAI ID in loan accounts. This is about CERSAI. Next one, quick mortality accounts. Cutoff limit is 15 lakh and above liability, becoming NPA within a period of 12 months from the date of commencement of repayment of either interest or installment. That is definition of quick mortality. In respect of limit sanctioned to the concerned borrower for the first time. That means new parties, first time availed finance, 15 lakhs and above, become NPA within 12 months from the date of installment, from the date of repayment installment. Then it is called as quick mortality. Next, credit monitoring officers at branches. Credit monitoring officers, fund-based for non-fund-based, 50 lakhs and above, they are eligible. CMOs are to, they have to monitor 50 lakhs and above loans at branch level. At branch level, credit monitoring committee is there, branch head, SM of credit and CMO. They have to meet weekly and discuss about accounts, if any, SMA 0, SMA 1, etc. They have to discuss. CMOs to utilize large credit monitoring module for monitoring. ROs to conduct CMOs meet quarterly and review functioning of CMOs. Any specific observations in accounts? Yeah. Any specific observations in accounts of more than 10 crore and above, a copy to be endorsed to CAMWing HO. And CMOs, they have to do risk rating under manual model, that is about 20 lakhs to 2 crores. Right? Next, special mention account, SMA already and default borrowers, SMA 0, SMA 1, SMA 2, all the old concept only. Just I will not go through much deeply. And CRILC report mainly, it is monthly, all borrowers with exposure of 5 crores and above. CRILC report is to be submitted. And SMA status, it is to be mentioned in that monthly report. Every Friday, borrower entities with exposure of 5 crores and above who are in default, banks have to report to CRILC weekly. Any default of single day also, 5 crores and above people, it is to be reported to CRILC. And subsequently, if it is upgraded, that means if recovery is made in that account, next week it should come in out of default report. If recovery is done means, again weekly out of default report, its name should appear. Next, SMA 1, SMA A, B, C, D, E, up to 5 lakh rupees SMA 1, borrowers with 5 to 10 lakhs, 5 to 25 lakhs SMA B, SMA C 25 lakhs to 100 lakhs, SMA D 100 lakhs to 500 lakhs, SMA E above 5 crores. This is classification. Next, monitoring. Branch head, all 5 categories, branch head has to monitor. RO head 25 lakhs and above, he has to monitor. 100 lakhs and above, CO. HO 5 crores and above, HO monitoring. SMA data is available every week as on Fridays in BO reports. BI report number is given. Okay. Next, IVR blast calling is done in respect of all borrowers other than agriculture and corporate balloons having exposure up to 1 crore and overdues below 10,000. Here IVR blast calling is done. And manual clearing is also done for SMA borrowers having exposure up to 1 crore. These are monitoring. Next, follow-up of recently slipped NPA accounts, new NPA monitoring desk. For daily follow-up of slipped accounts, BI report 291003. For follow-up of any particular period slippage from so-and-so period to so-and-so period, BI report 291017B. And follow-up of new NPAs here, up to 25 lakhs CRM section, RO will follow. 25 lakhs to 1 crore CRM section or recovery section at CO will follow. 1 crore and above up to 25 crore, new NPA section monitoring cell, CAM wing HO will follow. 25 crores and above monitoring section at SAM wing HO. This is who will follow basing on liability. Next, large credits monitoring. Applicable for this monitoring, this is applicable for fund-based and non-fund-based 1 crore and above. All details of borrowers and periodical statements reports to be uploaded in PDF format. Here, pillar-wise data entry is there. MSOD, stock statement, book debt statement, etc. monthly uploading. QoS and HOS exposure 5 crores and above applicable, half-yearly uploading. ABS yearly uploading. Stock audit uploading, it is also yearly. Applicability it is given. Credit audit and pre-release, whenever it is conducted, it is to be uploaded. This is what large credit monitoring. Unit visit as and when, again stock inspection as and when, consortium meetings also as and when. Consortium meetings yesterday we have discussed, but normally quarterly it will be conducted. 25 crores and above, 25 crores and above, where we are leader, GM of the circle will attend for taking important decisions. And below 25 crores, normally DGM will attend. Suppose if we are not leader, in such cases, one executive will circle, they will attend the meeting. If branch is headed by scale 4 or scale 5, then they will attend meetings, routine meetings. This is what consortium meetings, and within 3 days, minutes is to be circulated. And these are also uploaded here. Credit monitoring and review format, it is quarterly, it is to be uploaded. GSTR 1, 2A, 3B monthly. Exposure working capital 5 crores and above, whom GST is applicable. ASM 250 crores and above, it is to be. Reports, all reports are to be uploaded for monitoring. This is what. Credit monitoring cells at branches, ROs or circles. Here, $50 lakhs and above, as already we have discussed at CMOs, same thing here. Stock statement, MSOD, computation of drawing power. NF 902 stock statement, it is submitted. It is to be submitted even if OCC is in credit balance. It is compulsory. And MSOD is applicable. This is several times recalled question. MSOD is applicable for industrial borrowers with working capital limits of 10 lakhs and above. Along with stock statement, they have to submit MSOD. So MSOD applicability, working capital limits 10 lakhs and above. With stock statement, they have to submit. Normally, debtors up to 90 days are considered for DP. Basing on type of business, more than 90 days also considered. Exposures of 5 crores and above, they have to submit GST returns also, along with stock statement. This is regarding stock statement. QoS and HOS, industrial borrowers, working capital limits 5 crores and above, applicability. And QoS within 6 weeks from end of quarter, quarterly operating system, they have to submit within 6 weeks from the end of quarter. HOS within 8 weeks from end of half year. This is submission. PIPR, Project Implementation Progress Report. This is also recalled question. Applicability is term loans 50 lakhs and above. Applicability to be obtained quarterly basis, they have to submit Project Implementation Progress Report. During implementation period means till completion of commencement of commercial operations. Till the time they have to submit. It is duly signed by CA or chartered engineer. Obtain LIE if LIE is there. LIEs are normally applicable. Project cost more than 50 crores. In that case, lender's independent engineer. LIE means lender's independent engineer. They will also monitor the progress and report to us. So we will appoint LIEs and fees will be paid by borrower. Obtain LIE if lender's independent engineer is appointed. LIEs ensure utilization of funds and timely completion of the project. LI services for non-infra projects with project cost more than 50 crores. LI will evaluate project, funds infusion, etc. through PIPRs. Normally, monitoring will be done by LIs and funds utilization that is by GA certificate infusion. High risk accounts 10 crores and above monitoring. Exposure of 10 crores and above. And all LCB accounts, including MSME sector and excluding agriculture, it is undertaken by CAM wing at HO. NCLT accounts monitored by SAM wing at HO. Agricultural credit, these are all 10 crores and above large borrowing accounts. Agricultural 10 crores and above monitored by priority credit wing at H2. Borrowing accounts with exposure of rupees 200 crores shall be subjected to review by CAM wing. And 25 crores and above SMA1 and SMA2 CAM wing will monitor. Consortium MBA accounts 50 crores and above by CAM wing HO. BGs more than 5 lakh review half yearly ongoing basis. This is monitoring. Next, cross default and financial. Cross default means if one account is in default, another account of the borrower group account, it may default. This is what cross default. So here definition I will tell you in detail. Listed, it is applicable for listed corporates with exposure 50 crores and above, listed MSMEs 1 crore and above. This is applicability, monitoring of cross default. Default with one lender that may trigger default with another lender. Some other bank, if it has become NPA, our bank also in future it will become NPA. This is what cross default. Default with any bank for more than 30 days, it is cross default. But if it is more than 30 days overdue, then only default is considered. It is quarterly monitoring through CRILC reports. Because in CRILC normally overdues are there, 5 crores and above, weekly reports it will appear. So through that it will be monitored. P&L covenants quarterly, balance sheet covenants yearly monitoring. P&L covenants, that is profit ratio, turnover, etc. Balance sheet may your ratios, current ratio, debt equity ratio, etc. Monitoring yearly. If deterioration is more than 10% in current financial covenant compared to those, suppose at the time of sanction, they have given financials, in that ratios we have arrived. And the current ratios are also we are doing. If variation is more than 10%, then it is called as financial covenants, breach of financial covenants. Pending documentation or incomplete documentation, 5 crores and above, review quarterly. Legal entity identifier for borrower entities. LE, it is a 20 character alphabet numeric, and 5 crores and above, it is to be obtained by April 30th, 2025, 5 crores and above, it is to be obtained. AOD, after 24 months, within 36 months, it is to be obtained. Now we go for schemes important one. Okay, and important one only, I will cover it maximum 10 minutes time, because I am giving this PowerPoint that you can avail and go through. Important points only we will go through here. MSME schemes may. Common guidelines here. MSME common guidelines. Generally, we are prescribing collateral security for MSME loans. All schemes, in collateral security, what is the priority we have to take? First priority is for paper securities which are eligible for your capital charge. Basal capital charge may we have seen NIC, NSC, LIC policies, KVP, bank deposit, all paper securities. It is first preference. So wherever collateral is prescribed, up to maximum amount, it can be taken, no issue. Up to 100%, full amount also it can be taken as collateral security, because they are risk mitigants and it will reduce your risk weight in case of capital calculation. Next preference is given for residential or commercial properties. If party is not giving any paper securities, then minimum 50% you take, up to 100%. Entire 100%, if he is giving residential property or commercial, no issue, we can take. There is no bar. That means for paper securities and residential or commercial properties, no bar, up to full extent they can be taken. First priority paper securities, second priority residential and commercial. Full extent you can take. And for remaining, if it is shortage is there, then remaining exposure, you can take either open land or industrial properties or both. But here restrictions, vacant land, it should not exceed 25% of required collateral. Vacant land should not exceed 25% of required collateral. Vacant land plus industrial property put together should not exceed 50% of required collateral. These are guidelines. So restrictions are there for vacant land and industrial land. No restrictions for paper securities and commercial residential properties. These are common guidelines for all schemes you have to keep in mind. So for clarification purpose, just I have given because questions 2-3 times appeared for this. And in any scheme, Mahila Vikas, here also, wherever security, of course, it is CGT MSc coverage is the Mahila Vikas. Earlier it was MSc Vijeta, minimum 10 lakhs and maximum 5 crores. Remaining all general guidelines. MSME star, earlier it was credit against property, loan against property. So here also your NAM, collateral ka NAM, 100% approved securities, land and building that can be accepted up to full amount, vacant land 25%, vacant plus industrial 50%. So general NAM here also it will come. Right? Next one. MSME smart professional. Smart professional may again loan quantum, it is loan amount minimum 10 lakhs, maximum 5 crores in metros, 2 crores in urban, and 50 lakhs in other areas. Okay. Here also your collateral security ka 75% of hard cost. Okay. Hard cost and soft cost here I will clarify because in schemes hard several times they says margin on term loans 20% on hard cost. Hard cost means wherever assets are created like plant and machinery, the land and building, or your equipment, etc. Wherever assets are created, then we call it as hard cost. And what is soft cost? Soft cost means interest during construction, we call IDC. Interest during construction is part of project report, but we will not finance or we will not disburse under term loan for interest during construction. Party has to bring from own sources IDC, interest during construction. This is soft cost. So hard cost and soft cost differentiation you should keep in mind. Hard cost means wherever assets are created, we are giving loan, that is hard cost. Soft cost is interest during construction or preliminary expenses. They are also not to be financed. So this is one more clarification for hard cost or smart cost. And next, in this scheme, above 2 crores, you have to take 2 valuation reports for smart professional. Above 2 crores valuation, 2 valuations are required for this, right? Vahan for vehicles. Caravan, this is also vehicles, commercial, heavy commercial vehicles, etc. Contractor may above 2 crores, you should obtain 2 valuers. Yes, this is what is, yeah. Contractor for loans above 2 crores, valuation of 2 reports, 2 valuers that you have to take. This is one addition, and already it has recalled question. Contractor and quantum, etc., etc. is same. Weavers Mudra, already it is discussed. GST, here also security norms, collateral comfort 75%, manufacturing 50 to 75, it can be reduced. MSc credit card up to 50 lakhs limits we can give within working capital. MSc credit card, MSc in for hotels, etc., etc. in maximum 25 crores, working capital maximum 5 crores. Leather, for in leather and non-leather, almost common guidelines here. That means ring fenced and not ring fenced. Ring fencing means entire turnover is routed through our bank account. We call it as ring fencing, right? And entire turnover is not routed, then we call it as a non-ring fencing, right? PEV study above 5 crores. Footwear, yeah. Footwear is also just like leather, same guidelines. Startups definition as per that, and up to 50 crore startup already discussed, it is under priority. And here maximum loan quantum is 10 crores for startups. For startups, may one extra condition is there. DSRA they have to create. Debt service reserve account. Yesterday we have discussed while term loans may debt service reserve account for 2 months. DSRA means for 2 months equal to repayment amount. They have to create separately DSRA, whether they bring upfront or out of future cash flows every month, certain percentage, 2% or 3% or 5% as agreed, they have to build up this DSRA. This is debt service reserve account. 5% here it is prescribed. 5% of cash flows may be retained to build up this DSRA. DSRA equal to 2 months repayment installments they have to create and keep in separate account, either KDR or running account. So this is special in startup mein DSRA, debt service reserve account. Pharma, easy equipment finance up to 25 crores borrower exposure and maximum 100 crores loan is there, basing on risk rating again. Vishwakarma scheme, yeah, this is important for current exam because recently it has come. This is for people who are hand tools using people or handicrafts preparing people, those who can do work with hands also or using tools. So these are all like your goldsmith, blacksmiths, etc. Vishwakarma scheme, for them it is applicable. Here it is in the form of working capital demand loan in 2 tranches. First tranche maximum up to 1 lakh and second tranche maximum up to 2 lakhs rupees. And first tranche repayable in 18 months, second tranche in 30 months. Here what is the support of government? Rate of interest up to 13% it is applicable. Out of that, interest subvention up to 8% by Ministry of Micro and Small Enterprises. Ministry, they will give up to 8% subsidy. And that is thereby the effective rate of interest is 5% only. Product code 3012 PM Vishwakarma. This is important for current year exam. Recently it has come. Canara Atidhi, it is just like hotels, etc. It is MSME Expo for exporters. Standby credit for capital expenditure are small and medium. What this is old scheme only. What this scheme says is, whenever we are renewing working capital limits of a party, at that time you sanction separate sublimit towards capital expenditure. Suppose in between they want to go for modernization or any repairs, replacement, etc. If they approach bank, it may take time till the time their production will be hampered. To safeguard that, what this is, some portion you sanction and keep separately. It is called standby for capital expenditure. What is the quantum? Up to 25% of original machinery equipment available with them, with maximum 25 lakhs, you sanction, keep aside. And margin is 15 to 25%. This is standby term loan. If standby term loan is not sanctioned and party has incurred, then we will go for reimbursement also. Here, reimbursement. Party may buy some old machinery or new machinery. Within 6 months, they may approach for reimbursement. It is permissible. And what is the loan quantum here? Up to 50 lakhs for new machinery, up to 15 lakhs for second-hand machinery. And second-hand machinery not more than 2 years old. Margin is 25% for new machinery, 50% for old machinery. Right? These are the 2 schemes. Remaining all standby, okay. SME, exporters, capital assistance, LUCC, old scheme only up to 10 lakh rupees. BSME, doctor's choice, this is also old scheme. BEML for earth moving the construction ke liye separate loan, gold loan, bill discounting, MSME Sugam BAS. So briefly, I have covered about these schemes, only important points on that. Remaining, yes, you may, I am giving this PowerPoint. Yeah, anytime you may go through this, sir. And any clarifications? Smart professional maximum limit is unlimited. Yes, smart professional, yes, they have not prescribed. Okay, it is not there. Review above 5 lakhs. What is this review? Review above 5 lakhs, half yearly review, and 5 crores and above quarterly submitted statement. They have to submit. This is in respect of bank guarantees. Yes. Project appraisal, project cost modified from 5 crores to 10 crores. Project appraisal, in case of project cost, 5 crores new parties, existing parties 10 crores. Then project appraisal, existing part low risk and normal is 10 crores, and moderate risk value 5 crores. That is norm. Yeah. So this is briefly about this. I will share whatever material today with our sir. It will be uploaded in our website material pass. So this is, thank you very much, sir, because next session our sir I will not stretch beyond this. Jagannath sir class is there. Please join at 2 o'clock for Jagannath sir session. Thank you, sir. Thank you. We will stop this video, share, etc. Break for lunch time. Yeah. Any further clarifications also, I will clarify, no issue. Okay, it is over. Yes, sir.